forming. It is on their behalf that this committee acts to ensure that the SEC protects investors, maintains fair, orderly, and efficient markets, and promotes capital formation, all key ingredients to growing a healthy economy with opportunity for all. Vigorous oversight is also needed to ensure the SEC is a good steward of its resources, both its time and its budget. A budget that has increased dramatically by more than 64% over the last 10 years, while the monitors to my left, right, and in front of me show the rapidly rising red ink of our national debt. Since Chair White's last appearance before our committee, we have seen both good news and bad news. First, the good. The SEC finally completed the Bipartisan Jobs Act rulemakings to implement the Reg A+ in crowdfunding titles. This is noteworthy and commendable. Further, the SEC has now asserted its jurisdiction to hopefully stop the Financial Stability Oversight Council from regulating asset managers like banks. This, too, is commendable. Regrettably, there is more to discuss that is not so commendable. On a 3-2 partisan vote, a pay ratio rule was pushed through, which may appease left-wing activists, but does nothing to protect investors or facilitate capital formation for small and medium-sized business. It does nothing to help struggling families get ahead. It is another example of the SEC squandering precious resources on rulemaking that, again, does nothing to protect investors or facilitate capital formation. Additionally, as much as left-wing activists may wish to drag the SEC into political advocacy, the Citizens United decision does not involve or implicate federal securities laws. A political disclosure rulemaking is not within the SEC's core competency, or more importantly, it is not within its mission. It would simply create more opportunities for abuse and politicized enforcement, as we have seen with the IRS scandal, and further damage the SEC's credibility. The SEC should instead redouble efforts to simplify the disclosure regime and renew its commitment to the materiality doctrine articulated by the Supreme Court in 1976. Instead of modernizing our proxy system, the Chair's recent action to cut off staff guidance to public companies in the middle of this past proxy season was ill-advised, and the universal proxy ballot proposal favors special interest in short-termism rather than benefiting the vast majority of public company shareholders. Finally, the SEC does have an opportunity to act and stop the Labor Department from making financial advice and retirement planning less available and more expensive for Americans with low and moderate incomes. This, we hope they successfully do. Real investor protection comes from innovative capital markets that are vigorously policed for force, fraud, and deception. They allow capital formation to flourish and give investors the freedom to make informed investment decisions free from government interference and control. I now yield 3 minutes to the ranking member for an opening statement.
Thank you very much, Mr. Chairman. Welcome back to the committee, Chair White. Today we gather to discuss the SEC's work to oversee our capital markets. This work, however, is hampered by harmful Republican cuts to your budget requests, which will make it harder for you to police these markets. Please know that Democrats are committed to full funding for the SEC because the Commission provides the first line of protection for investors. It has been 8 months since you were last here and more than 5 years since Dodd-Frank was enacted, but the SEC is still yet to propose a uniform fiduciary standard. I'm pleased to learn that certainly while the Department of Labor is doing its part to create a rule that works, that you are working toward this end, and that there should be something in the reasonable future dealing with this issue. Regarding the inadequate level of advisor exams, I join industry associations, advocates, and members of this committee in calling for a modest fee on advisors, and I'm concerned about any costly third-party exams which your staff may be working on. I'm also concerned, As we have discussed, I'm deeply concerned about the continued seemingly reflective granting of waivers of bad actor disqualifications. These waivers allow some of the worst actors in our financial system to continue business as usual. And I look forward to your explanation of exactly how these decisions have made. In recent times, I've learned that they're made quite differently than I thought. Lastly, I received your letter concerning a bill we considered last week related to business development companies. While this isn't quite the bill I would have offered, we did craft a compromise that I believe addressed most of your earlier concerns with the legislation. I also offered an amendment with Mrs. Velasquez to address your new concerns with BDCs owning investment advisors. We disagree relative to the modest increase in leverage, but I urge you to help us craft language to further improve this bill before it moves to the House floor. Thank you, and I yield back the balance of my time.
Gentlelady yields back. The chair now recognizes the gentleman from New Jersey, Mr. Garrett, for 2 minutes, chairman of our Capital Markets Subcommittee.
So I thank the chairman. I thank Chair White. It's good to see you again. And I may be echoing some of the comments that Chairman Hensarling has raised. And I do that because, frankly, the last time that you appeared before the committee, I noted my concerns back then over the large number of 3-2 votes that was occurring in the commission had taken over the last several years, as well as the general perception that the SEC is becoming, well, basically increasing politicized. Since that time, really little has happened to relieve any of those concerns that myself or the chair or others have raised. In fact, in the last 6 months, the SEC has prioritized and completed the very partisan and politicized pay ratio rule and is right now in the process, as you know, of developing a universal proxy ballot rule. And in essence, these two are two priorities that may appease the special interests, but they really do very little to make our capital markets more competitive. So while I'm pleased that the SEC has at last finalized the crowdfunding provisions of the Jobs Act, I would note that this was also done along a partisan vote, 3 years after the congressional deadline. At the same time, the SEC's ongoing failure to develop what I might call a capital formation agenda remains one of the most serious deficiencies. And it seems that the only time the SEC actually modernizes the securities laws to the benefit of the growing number of businesses is when we here in Congress tell you to. Now, tomorrow, the SEC will host for the 34th year in a row the annual Government Business Forum on Small Business Capital Formation. That's good. As in previous years, I expect this forum to produce a number of valuable ideas that would help small enterprises get capital and grow. But, as in previous years, I also expect that the majority of these recommendations will be basically ignored by the SEC. Finally, the SEC clearly has an important mission and role within our sector, financial sector, but right now it's up to the agency has got to get its priorities in order. And so I look forward to hearing from you today on how the SEC can refocus on its threefold mission for the benefit of America's capital market. I yield back.
Gentleman yields back. The chair now recognizes the gentlelady from New York, Ms. Maloney, for 2 minutes, ranking member of our Capital Markets Subcommittee.
I thank the chairman for holding this important hearing and welcome, Chair Lady. Quite a bit has happened since Chair White last appeared before this committee in March. For starters, the SEC has finalized several rules, such as the CEO pay ratio rule and 2 Jobs Act rules. Perhaps most importantly, the extreme volatility in the markets on August 24th was the first real-world test for many of the market safeguards that the SEC put in place after the flash crash of 2010. In particular, the automatic trading pauses for stocks that experience extreme volatility, known as the limit up, limit down rules, were triggered nearly 1,300 times on August 24th. And a lot of the stocks that were halted that day were exchange-traded stocks rather than stocks of individual companies. Many stocks that were temporarily halted had trouble opening up again because when they opened back up for trading, their prices rose too quickly, which triggered another automatic pause. However, despite this widespread disruption, the market-wide circuit breakers, which would have halted trading on the entire market for 15 minutes, were not triggered on August 24th. So I will be very interested in hearing Chair White's perspective on how these new safeguards performed. Did they work as intended, or are there problems with the safeguards that need to be fixed? I thank you, and I yield back, and I look forward to your testimony.
Gentlelady yields back. Today we welcome the testimony of the Honorable Mary Jo White. Chair White has previously testified before this committee, as we all know, so I believe she needs no further introduction. Without objection, Chair White, your written statement will be made part of the record, and you are now recognized for 5 minutes to give an oral presentation of your testimony. Thank you.
Thank you. This is on, right? Okay. Chairman Hensling, Ranking Member Waters, and members of the committee. First, thank you for inviting me to testify about the recent activities and current initiatives of the U.S. Securities and Exchange Commission. Since I last testified before this committee in March, the SEC has advanced significant rulemakings, continued to bring strong enforcement actions against wrongdoers, and made significant progress on our initiatives involving the asset management industry, equity market structure, and disclosure effectiveness. The Commission has adopted or proposed 17 substantive rulemakings in the past 8 months, including rules required by the Dodd-Frank and Jobs Acts, and these efforts have included final or proposed rules addressing over-the-counter derivatives, new means for small businesses to access capital, including the final rules, as the chairman mentioned, both for updating and expanding Regulation A and for allowing securities-based crowdfunding offerings, enhanced oversight of high-frequency traders, and our supervision of investment advisors and mutual funds, amendments to the SEC rules governing its administrative proceedings, executive compensation disclosures, and removing references to credit ratings from our rules. The Commission also approved a proposal by the National Securities Exchanges and FINRA for a 2-year pilot program that would widen tick sizes for stocks of some smaller companies. Our enforcement program also continued to deliver very strong results, with the Commission bringing 807 enforcement actions and obtaining monetary remedies of approximately $4.2 billion in fiscal year 2015. Of the 807 enforcement actions filed, 507, a record, were independent actions for violations of the federal securities laws. More important, though, than the numbers, these actions addressed meaningful issues for investors and the markets, spanned the securities industry, and included a number of first-ever kinds of actions. Significantly, approximately 2/3 of our substantive actions in fiscal year 2015 included charges against individuals. The Commission also continued to seek admissions, including the first-ever admission settlement with an auditing firm, and to pursue complex cases with criminal authorities, including a recent action charging dozens of defendants with a global scheme to profit from hacked non-public information about corporate earnings announcements. Going forward, we plan to continue to focus on completing our mandatory rulemakings while pursuing other initiatives that are critical to our mission, including those relating to asset manager oversight, equity market structure, and disclosure effectiveness. This afternoon, for example, the Commission is expected to consider new rules to enhance the transparency of equity alternative trading systems. We will also continue to strengthen our enforcement and examination programs, striving for high-impact efforts that protect investors and preserve market integrity. And we'll continue developing a number of ongoing initiatives designed to facilitate capital formation, particularly for small businesses. The agency's fiscal year 2017 budget request to the Office of Management and Budget reflects these priorities, focusing on the execution of our core programs and operations by seeking to hire individuals with the skill sets necessary to enhance the agency's oversight of increasingly complex securities markets, striving to build the significant new oversight programs assigned to the SEC in recent years, and continuing to enhance our technology, including our ability to analyze and assess large volumes of data. As we continue to place a high priority on allocating our resources efficiently and effectively, I was very pleased that the Commission recently received an unmodified audit report, the agency's best ever audit opinion from the GAO, with no material weaknesses or significant deficiencies identified in fiscal year 2015. We plan to build on these improvements and continue to enhance the execution of our mission. The Commission's extensive work to protect investors, preserve market integrity, and promote capital formation is not limited to the initiatives I have just summarized today or in my written testimony, but I've tried by example, both here and again in the written testimony, to convey the breadth and importance of the Commission's ongoing efforts and provide a sense of our progress in the last few months. Thank you for your support for the agency's mission and for inviting me to be here today. Your continued support will allow us better to protect investors and facilitate capital formation and more effectively oversee the markets and entities we regulate. I would be happy to answer any of your questions.
Thank you, Chair White. The Chair now yields himself 5 minutes for questions. Chair White, it was reported that you announced at a conference recently that the SEC is, quote, full out focused on developing its own fiduciary rule. I alluded to it in my opening statement. You were last here in March, and we've spoken about these matters both publicly and privately, but it is my understanding the SEC staff has not yet performed an updated analysis of the potential impact of a uniform fiduciary standard on retail investors. Is that correct?
The answer is in terms of there's not another 2011 study that's been done. As we proceed with this, the staff's recommendations, which are in very much in process, actively in process.
Is there any work being done to update the 2011 study?
Part of the rulemaking as it advances will be very deep economic analysis by our economists at the SEC to judge impacts as well as all relevant baselines, and it's enormous.
Will that analysis be complete before the proposal of any uniform fiduciary standard?
Certainly there will be economic analysis that is complete before there's any proposal. There's always additional economic analysis, as there should be, before you proceed with any adoption, but certainly that will be part of the proposal process.
But not necessarily the complete analysis that the staff is.
Not necessarily, but it really depends on how it's assessed as we go through that process, including with our economists.
Will this analysis be shared with this committee and made public prior to the proposal of any uniform fiduciary standard?
I mean, typically, unless there's a paper produced separately, which happens from time to time from our DERA folks, it's part of the proposal and made public in that way.
We would encourage you to do that. Chair White, I don't know if you share the concerns that many share on this committee in looking at the experience of a similar proposal in the UK. The public sources that I've been able to access show that they imposed a similar fiduciary rule that 310,000 clients stopped being served by their brokers because their wealth was insufficient to advise profitably. 60,000 investors were not accepted as new clients for the same reason. And in the year before the commission ban went into effect, the number of advisors serving retail accounts plunged by 23%. Does the experience in the UK concern you?
I'm familiar with several, actually, UK analyses. I mean, clearly a concern of this rulemaking is what impact does it have on the ability of retail investors to get reasonably priced, reliable advice. And as I think I've said before, part of this rulemaking process will be very much devoted to what impact it will have on precisely that.
I would hope that the SEC would look very closely at the UK experience and also look at, I hope you have received similar testimony that we have received, that the best interest contract exemption is frankly unworkable and not an exemption at all, meaning that the UK experience is most parallel. Switching subjects to bond market illiquidity. Again, you last appeared before us, I guess it was 8 months ago in March. You acknowledged the concern about bond market illiquidity, and again, we've spoken about these matters both publicly and privately. Since you testified that at that point, you did not see a link between the Volcker Rule capital requirements and reduced bond liquidity, it has been 8 months. In that intervening 8 months, on May 20th, the Wall Street Journal reported that the number one concern of financial professionals was lack of liquidity in the markets. In August of 2015, PricewaterhouseCoopers published a study that attributed, quote, the measurable reduction in financial market liquidity to multiple factors, including bank de-risking due to new regulatory frameworks. Last week, the Wall Street Journal reported that the U.S. firms are holding negative corporate bond inventories for the first time since the Fed began reporting this separate data. The chair of FINRA has testified in this committee, quote, there have been dramatic changes with respect to the fixed income market in recent years that has led to much higher capital requirements, the Volcker rule that limits the ability for proprietary trading with respect to bank holding companies, a range of other issues that have all had significant impact from the standpoint of liquidity of the fixed income market. So since it's been 8 months since you've last appeared before us, there has been news. Have you been able to determine whether regulations like the Volcker rule are a contributing cause to the dramatic decrease in liquidity in our fixed income markets?
I'd like to say that it remains a concern of mine, as I testified 8 months ago. I think it does of all regulators. But the answer to your question, direct answer to your question, is no, as is reflected in the quarterly reports that we make actually to this committee on that subject with our fellow financial regulators. I think the most recent one reflects both levels of liquidity in the primary and secondary markets as set forth there, and the conclusion that one cannot determine impact from the Volcker rule. Obviously, there are a lot of factors that, including capital requirements and others, that go on. I do note that at least recently, reports do indicate that dealer inventories have gone into negative territory, and that's something that obviously we will be looking very closely at before the final report for this year. I'm not trying to get ahead of the report, but we'll be looking very closely at that, both for its existence, its meaning, and whether impacts can be judged.
My time has expired, but Chair White, the rest of the world is concluding otherwise, so I would hope the SEC would pay very careful attention. The Chair now recognizes the ranking member for 5 minutes.
Thank you very much, Mr. Chairman. Chairwoman, you've been asked, you will be asked today about your efforts on a number of issues. And I'm appreciative for your response on the fiduciary duty rulemaking. But just for a second, would you please explain to us how a lack of adequate funding does not allow you to move as quickly as we would like you to move on some of these issues? Are you at all hampered by inadequate funding of the SEC?
Well, we clearly, and I've testified about this before, we have responsibilities far beyond our resources. And so we obviously try to make the smartest decisions we can in core areas, in new areas we've been assigned since Dodd-Frank and the Jobs Act. But clearly, it becomes a zero-sum game, as they say at some point, and it does slow you down. Of course it does.
Well, thank you very much. With that, I'd like to just have you describe to us the SEC waiver process. The last time you testified, I expressed concern with the SEC's policy of providing waivers of disqualifications to bad actors on a seemingly reflective basis, and I questioned the transparency or whether or not there should be public input. As you know, I have a proposal that I think would remedy this problem that would, among other things, require the process to be conducted and voted on by the commission level, provide the public a notice and comment period and an opportunity to request a hearing, and require SEC staff to keep complete public records of all waiver requests and denials, and create a public database of all disqualified bad actors. So here I am, even with the bill, talking about more work for you in this area. Before I go any further, because I know this is a little bit more complicated than most people think, would you explain to us a little bit about that process?
Yes. First, I want to make it clear that the SEC very aggressively pursues financial institutions and senior corporate executives, and our record bears that out during and after the financial crisis. So when it comes to disqualifications and waivers, it's very important to understand that those are not enforcement remedies. Those are separate provisions in the securities laws that are governed by their very separate rules, very separate guidances, that the Commission and the Commission staff apply very vigorously, case by case. When an enforcement action of ours or someone else may trigger a disqualification, and then if a party is seeking a waiver, and it's typically a waiver to be allowed to pursue or continue to pursue business in a totally unrelated area than the enforcement action was about. The burden is on that party to show us that to simplify it a little bit, it would be in the public interest to grant that waiver. The staff, in order to increase transparency and robustness, has upgraded under my tenure and at my direction guidance on the WIXI waivers as well as the bad actor waivers. And I think the commission and the staff work, do very deep dives and apply those standards quite robustly before making those decisions. If a waiver is granted, it is made public on our website. If a waiver is not granted, typically the party will withdraw the request for that, and it includes non-public information. So one of my challenges because I think if you look at only the public record, you think we're granting them routinely in all of them, and that is not the case. There are many, many that we do not grant, and so a challenge is preserving the privacy of non-public information, but yet being able to provide publicly the information that shows that we're not granting these waivers as they are requested each time. It's a very robust process.
I'd like you to take a look at my legislation and see if there's anything that we could do with that legislation to help you improve the process if you believe there's room for improvement. Lastly, on BDCs, you've written a letter to us with your concerns. Others are concerned about support for small businesses, and we want to make sure that we do everything to create resources. Can you help me understand what your concerns are a little bit better and what we can do to make the bill better?
First, let me say that I think BDCs are designed to be an engine for economic growth, and particularly for small businesses, and that's good for everybody. And it's something that the staff and the commission have been supportive of throughout the years, frankly, since they were set up. And I appreciate, by the way, that some of the concerns that I'd expressed a couple of years ago with the prior bill were addressed. Happy to talk about it further, but I did recently submit a letter to you and to the chairman expressing my concerns with certain aspects of the current bill, really investor protection concerns that are significant concerns that I felt that I really must express. Obviously, it's up to Congress what they do, essentially in several areas, but primarily the increase in leverage, as well as the reduction of rights, if I can again oversimplify a little bit, in preferred stockholders. Kind of net, you also end up under the proposed bill allowing a BDC to invest 50% of their assets in a financial institution. It used to be 30%, and the core objective for the BDCs is really to invest in operating companies and new operating companies that you want to give a boost to. And these are retail investors that we're talking about who own the vast majority of BDC shares, so that obviously heightens whatever investor concerns we have.
Thank you very much, Mr. Chairman, and I hope you'll work with us to improve the legislation. Mr. Hines.
Chair now recognizes the gentleman from New Jersey, Mr. Garrett, Chairman of our Capital Markets Subcommittee.
Thank you. So, Chair White, so when you were here once before, I opened with the statement, are the markets rigged? Let me follow up now with, is SIPC rigged as far as the coverage that you get from there? And does the small investor actually know that he has no coverage under SIPC with his statement? Let me give you a quick example. Years ago, I invested $2,000 when I came out of college in the marketplace. And over 30 years now, the market's gone up, it's grown. I've gotten dividend payments out, I've gotten capital gains. I withdrew some money over the years to pay taxes and do likewise. So over the last 30 years, my statement says it's going up and up in value. I've taken out that $2,000 that I initially invested. As I understand it, my SIPC coverage right now for my statement, which says I have well over that $2,000, I have about $5,000 or $6,000 in account, my SIPC coverage is exactly 0. Is that correct?
Excuse me, as I heard your scenario, that is correct because of what SIPC is designed.
So I have 0 coverage,
Well,
even though my statement is telling me I have like $5,000 in there, but there's a statement, indication on the bottom of it that I have, it's SIPC covered. On the statement when I go to the broker-dealer, his has a logo right there. Does anyone have an obligation to inform me that I have absolutely 0 worth of coverage on my brokerage statement? Whose obligation to tell me that? Is that
Well, first of all, your account statement should be accurate, and obviously what's sort of given rise to these concerns is a huge Ponzi scheme, where the account statements are false.
Right, but who should tell me that I have
Basically.
0 coverage right now?
The broker should tell you, but the broker in question may be committing a massive Ponzi scheme, so you may not, you may not get that
So
disclosure.
it is a fiduciary duty of the brokerage or the investment advisor to tell me that I have 0 coverage?
I'm not sure I can give you a legal opinion on that, but what I can say is that what SIPC covers covers is what securities and cash that the broker has custody of. So if, for example, in your example, that when you put in your $2,000, you had invested in certain securities
Right.
that had appreciated, so there were securities in the hands of that broker,
Right.
they would be covered by SIPC. But if instead, what your broker did was essentially never engage in bona fide trades, it doesn't protect against fraud, which is really what we're talking about, I think.
Well, we don't know exactly what it is, but I'm a simple investor. I think I have this much money. I find out that something went wrong. It's not the market issue. But in actuality, your answer to the first question is I have zero coverage. There is an obligation of someone, I guess the broker, to tell me this. And at that point, the wise thing for me to do would be what? To move down the street to another brokerage account, because then my coverage would go back up. Is that not correct, the full amount that I've invested?
Well, if you put that amount in that broker's custody, it would be covered by SIPC.
Right, so the new account. So investors should be told the smart thing to do is once you have withdrawn the initial investment, the smart thing to do is to move to another company.
But keep in mind, if you'd withdrawn your $2,000, but it had appreciated with securities to $7,000, and the broker had those securities and then went under, you would be protected to that $7,000.
Not from SIPC, however.
No, you would be protected by SIPC if, in fact, you had invested that $2,000 at some point in securities, and it was still with the broker. What you're not covered for is essentially these Ponzi schemes that are reflected falsely on your account statements.
So it depends on how the investments are made, in other words. So I, as an investor, now need to know when I get this statement whether the investments are being done like in a Madoff situation or whether the investments are being done some other way. So it really depends. How is the investor supposed to know that, whether he's really getting coverage or not then?
And of course, the problem is in the Madoff, and it's a huge problem, obviously, in the Madoff situation, is that the investments weren't being made. And so you had a massive Ponzi scheme. So you were being defrauded kind of from beginning to end.
So the bottom line, me as a simple investor, and that's really describes me well on these things, I don't know how that's being done, and I really don't know whether SIPC is going to be there at the end of the day. I ought to move on because there's a bunch of other questions. The Reg D and Regulation D and the Rule 506 under the Dodd-Frank Act, real quickly here. So you've proposed some amendments to that, and the question is what is the effect of those amendments on the marketplace? The SEC's Division of Economic Risk Analysis said that only 2%, or $33 billion, of the capital raised under Reg D has come under 506 of the Jobs Act, which we did. That would sort of tell me that there's a suppression effect of their amendments just hanging out there. Can you withdraw those amendments so that we can actually get the full effect of the Jobs Act and 506C of Dodd-Frank?
As you mentioned, those amendments, there hasn't been consensus on those amendments, and they've not moved forward. I do think they're important, however. I still believe they are important to give us greater information, greater clarity into how the markets are operating. Obviously, we have a year and a half of operation now, and we've had an interdivisional group sort of looking at those markets. I've also inquired about, because, I've obviously heard the concern that just the fact that regulation is proposed may be hampering those markets. The feedback that I've gotten, at least from our folks, is that they don't believe that's the case. That's not a definitive finding.
Right.
But clearly, the 506C market, it has been used, but not as much as one might have anticipated, and certainly not as much as the 506B market has been used.
2%. Thank you. I'll yield back.
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Velasquez.
Thank you, Mr. Chairman. Chair White, recently it was reported that UBS was underwriting bonds for Puerto Rico's retirement system and then placing the same bonds into mutual funds that were sold to customers on the island, something that will be prevented by the Investment Company Act of 1940. However, due to the high cost of air travel at the time the act was passed, Puerto Rico and other U.S. territories at the time, including Hawaii, were exempted from the 1940 Act. I have recently introduced legislation, H.R. 3610, to close this loophole and ensure that Puerto Rico and other U.S. territories have the same protections as states do. Do you believe that this loophole should be closed?
Well, let me say I share your concern. I think when the exemption was put into law, it was many, many years ago when the thought was that just the practical and financial difficulties of being able to sort of enforce that law in the territories was just not there. Today's a very different world, so I share your concerns. I think the loophole should be closed.
Thank you. In the ongoing financial crisis in Puerto Rico, hedge funds are playing a significant role. It is impossible, however, to fully understand the scope of their investments. Some disclosure requirements are only available to regulators, while others do not cover debt securities or derivatives. I recently introduced legislation, H.R. 3921, to close these loopholes and increase disclosure requirements on hedge funds. Do you believe that further disclosure in this area will benefit investors and the public?
I think I would have to study it further, the precise parameters of it. I can see pros and cons, frankly, to that approach. I mean, clearly registration and reporting are critical to increasing transparency and protecting investors in private funds. And this has been, looked at very closely in connection with Dodd-Frank when we were given authority over private fund advisors, and there is a lot of information that's actually produced on Form PF, by hedge funds and others. But the judgment was made then, not to basically expose or expose more than was prescripted to be exposed, the actual holdings and strategies of private funds, whether hedge funds or not, because that could lead to front-running and other kinds of actions with respect to that kind of disclosure. So there are pros and cons to that. I'd need to study it further.
Okay, thank you. And I hope that we could work with your office at least to hear some feedback regarding the legislation. Another issue that has come to our attention and that I care about as ranking of the Small Business Committee is the small business online lending industry that has grown rapidly in the past 5 years, and experts are expecting double-digit growth through 2020. Last week, I sent a letter requesting information on your agency's involvement with small business online lending. Is there anything, any preliminary comments on my request?
I've seen the letter. We will obviously be responding to it in due course. I mean, just as a terms of what our space is with respect to online lending, we don't regulate the loans themselves, the lenders, as in the terms of the loans to borrowers. That's not in our space. However, we do regulate online lenders when they sell securities to investors to essentially fund these loans, whether through notes or investment contracts. They may need to register the offerings. Some platforms, depending on how they do it, could have to register as broker-dealers. We have brought cases in the enforcement space on some of this, but our jurisdiction, really relates to protecting investors if in fact there are offerings made under the federal securities laws.
Thank you. I yield back.
Gentlelady yields back. The chair now recognizes the gentleman from Texas, Mr. Nagelbauer, Chairman of the Financial Institutions Subcommittee.
Thank you, Mr. Chairman, and thank you, Chair White, for being here today. I want to go back to a line of questioning that the Chairman was talking about, something I've had a great deal of interest in, and that is the fixed income market. Can you tell me exactly what resources at the SEC are dedicated to the fixed income market?
And I think we may have had this discussion at our last hearing. Primarily, but it clearly is not confined to our trading and markets division. And it's not segregated out as a separate unit, which I think we did talk about before. And I've had conversations, but we have, 15 to 20 trading and markets folks who primarily deal with the fixed income markets. We clearly have the Office of Municipal Securities, which is a relatively small office, but in the muni space, deals exclusively with that area as well. And so, and I've had several conversations with Steve Luparello, particularly, who's our Director of Trading and Markets, about the need for additional resources, perhaps a restructuring so that we make sure that the fixed income markets are getting the attention that they deserve. And I think, certainly in his view now, and he's persuaded me, I think we're structured as we should be and resourced as we should be, although I will note that in our budget request, I think it's for fiscal year, 2016, we're obviously operating under CR now, we sought an additional 15 positions in trading and markets, and at least 2 of those are will relate exclusively to a study assessment of the fixed income markets.
And that's in the future, but today, there's how many people doing that?
I would say in trading and markets, the last time I asked for that sort of number, and again, they don't, it's not, it was about
But
16,
just
about
for
16.
just for corporate bonds.
Yeah, it's not counting the muni securities, about 16 was the last number I was given. I mean, it's a rough number, Congressman, if I may say, because it's not how it's structured, because there are other people that work in the space as well that, don't devote the predominance of their time. Yeah.
Back in August, PricewaterhouseCoopers released a study on what they call the brittleness of the liquidity in certain asset classes, and the study's findings are of concern to me as it highlighted specific areas where liquidity had measurably declined, including difficulties in executing trades, the reduction in market depth, increase in market volatility, and the bifurcation in liquidity. The study also notes that pending or future rules and regulations could have further significant impact on the market-making activities as we exit a historic period of accommodative monetary policy. Are you aware of the Pricewaterhouse study? Have you read that and looked at it?
The answer is, I've read a number of studies, and I believe that one as well, and certainly our staff has. And it's also something that really both in the trading and markets area and the investment management area that we've been very attuned to and in dialogue with market participants about those risks and those eventualities, particularly when interest rates go up.
Yeah. So I mean, market liquidity is a pretty big deal, isn't it?
It certainly is.
Well, I think the concern that I have, and I think others have, is we're not sure that your agency is giving the attention to it, because we hear that from a lot of different market participants that the liquidity issue is a real deal. And so I would hope that as you move forward, that if you are doing studies in that area, that you would share some of the findings with this committee. I want to move to, in 2015, Commissioner Stein and Piawar released a statement supporting proposals to shorten the trade settlement cycle for certain security transactions. Industry groups in the Commission's Investor Advisory Committee encouraged the Commission and market participants to move forward on reducing the settlement cycles, citing that it would improve investor protections and reduce systemic risk. Additionally, an industry-led committee of members across the securities industry issued a white paper outlining the timeline and actions required to move from T3 to T2 settlement cycle for transactions in the United States in the third quarter of 2016. Do you agree with moving to T2?
The answer is yes, is the direct answer. And we actually responded to a letter, I think it was from SIFMA and maybe others as well, to me. I think the letter was addressed to me as to both the position that I took on it and also asking for regulatory support, to help bring that about. And so my letter was quite supportive. It's public. We can certainly provide that. And I think the only thing I wanted to be sure of is that it didn't foreclose possibly, down the road, an even shorter settlement period.
So why haven't y'all acted on that?
I mean, I think it's not timely to act on it, but I mean, we will act timely.
What is timely?
Well, I mean, essentially, we're and again, the letter reflects this. We're because I think they've gotten traction. We're allowing the industry coalition, if I can call it that, to get to the place where their systems can actually accommodate the T+2, and so the regulation they need will be in place by the time that happens in 2016.
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Maloney, ranking member of the Capital Markets Subcommittee.
Thank the Chairman. Chair White, as I mentioned in my opening statement, I am interested in the events of August 24th in the markets. The extreme volatility that day meant that the SEC's automatic trading halts for individual stocks were triggered nearly 1,300 times. And I know the SEC has said that it is collecting data as quickly as possible to analyze what happened and to determine if there are any changes to the agency's rules that are necessary. Can you give us a sense of where this preliminary review, what you have found in this review?
Yes, it's well along. I mean, and I'm expecting that we can share some initial results from that review in the near term. I think, and you're absolutely right. As you commented earlier, we obviously had We didn't invite the mini stress test on August 24th, but we had one. The markets did perform quite well, but clearly there were issues that came out of that. And one of the significant ones was obviously the market-wide circuit breakers, as you said, were not triggered, just given the amount of volatility, the timing, and so forth. But we did have a large number of limit up, limit downs, trading pauses, and particularly with ETFs. Most of them were in ETFs, although interestingly, not on all ETFs, and so even with the same underlying security. So it's a more complex issue, which we're studying, and in part what we're looking at is obviously we have the limit up, limit down rules in place, which were put in place as a volatility moderator after the flash crash. It's on a pilot basis, and so one of the things that we're very, very interested in is the data that comes out of August 24th as to what modifications, if any, what calibrations should be made in the limit up, limit down rules. We're looking very closely at the opening of the markets as well, because that's when the majority of all of this occurred, and there were somewhat delayed openings, particularly on the New York Stock Exchange.
Will this information or this analysis be available before the end of the year?
I hope it will be. I don't want to commit to it, but I would hope it would be.
Okay. Last December, you outlined a comprehensive plan to update the regulatory regime for asset managers in order to account for the significant changes that this industry has undergone in recent years. The SEC has now proposed 2 of the rules that you promised, enhanced disclosures and the liquidity management rules that you proposed in September. But we still haven't seen the 3rd rule yet, which will require transition plans for winding down asset managers. Can you give us an update on this 3rd rule, and when can we expect this rule to be proposed?
I think the next in the series, this is obviously, it could change, but just in terms of the workflow, will probably be the rule on derivatives, and then following that would be the transition rules and also stress testing, which are, it's really, I think I categorized it as 3, but it's really sort of 5, separate areas. And so in terms of the transition planning rules, which is essentially, designed to, have funds and the industry be able to deal with disruptions in their business, in an optimal way. That will not be this year, I think, in terms of a proposal, but I would hope it would be relatively early into next year.
Okay. In terms of the stress test, when do you expect the SEC to propose a stress test rule for large asset managers? And secondly, what are the challenges that you've encountered in developing stress tests for large asset managers? Why is it such a challenge?
It is a challenge, and it's probably the 5th in the 5 that I mentioned, and the staff's working on them all at the same time, and working very hard on it. But they're not banks. I mean, and so one first can't just transfer stress testing for banks, into this space. And so to come up with a meaningful test for very different funds with different kinds of assets, different kinds of stresses that matter is a real challenge. So, but we're working very hard on it. It's actually a requirement under Dodd-Frank.
Okay. Lastly, I'd like to ask you about the SEC's use of administrative proceedings. And as you know, Dodd-Frank expanded the SEC's authority to try cases in an administrative forum where decisions are made by law judges rather than always having to go to federal court, which is expensive and time-consuming. Some critics have claimed that the SEC's administrative proceedings amount to an unfair, quote, home court advantage, end quote, and some have even claimed that they deprive defendants of due process. Can you speak to these issues? How do you feel about it? Do you think the SEC does get an unfair home court advantage when they try in the form of an administrative law judge? And what protections are in place to ensure that defendants are still receiving their full due process?
Administrative proceedings and administrative law judges have been used by the SEC for many, many years, as well as other federal agencies. Congress obviously gave the SEC, as well as other federal agencies, the ability to bring enforcement cases in either district court or administrative proceedings. With respect to the SEC, we have a lot of expertise in our administrative law judges. They deal with very technical kinds of issues. They're impartial, and they have unique due process rights, not the same as a district court, but for example, unlike in district court, if you're a respondent in an administrative proceeding, we provide Jenks and Brady material, which is essentially exculpatory information. That's not required in district court. we turn over all of our unprivileged investigative file. We've also proposed, actually, for notice and comment amendments to our rules of practice to provide additional rights for defendants.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Missouri, Mr. Luca Meyer, chairman of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman. Ms. White, thank you for being here today. And I want to start off my questions with regards to designation of insurance companies as SIFIs. As chair of the Insurance Committee, Subcommittee, it's concerning to me. As we continue to discuss this issue with a lot of the insurance industry folks, as well as those insurance companies that have been designated, can you tell me the specific standards that you looked at whenever you voted in favor of designating 2 of our domestic companies as SIFIs over the objection of the insurance expert on FSOC?
I think we may have talked about this in March as well. I participated, I think, in the AIG and the MetLife cases, not the others. I mean, just
I'm aware of that. That's why I said just.
That's why you said 2. That's why
right.
you said 2. And the MetLife designation, as you know, is in litigation, so I'm somewhat limited as to what I can say. But what I can say, because the statutory criteria are in the statute in public, FSOC's guidance as to what it looks at is public, and then.
Okay, so my question, though, is what standards did you look at that were different or more significant to you than what the insurance expert on FSOC said were not something that, in his eyes, rose to the level of designated as a SIFI?
Well,
where's to you the alarm or the connection?
I mean, I think it's sort of hard to get into granularity on that, I think, but obviously we get very detailed presentations and analyses from the staff. We have a standard we're applying and looking for certain criteria. I was satisfied that those were met in that instance.
Okay, one of the questions.
But I must say, listening very carefully and respectfully and understanding the knowledge that the insurance representative brings to bear on this.
But you still went against them.
I made my independent decision, yes.
Okay. The other question that we always get is, or concern that we always get from the insurance industry folks, is we need an off-ramp. We need some way, some sort of a mechanism or a delineation of things for them to do to become de-designated. Would you support something like that?
It exists to a degree, so I mean it's important to know that because there's actually an annual review process of any company that is designated. I think what
with all due respect, Madam Chair, that's not a delineation of things for them to do to. That's just a list of this. All that is a report of where they're at. It doesn't tell you what.
Well, again, what a company that's designated will have received, and again, will have received is a very detailed analysis for the basis of the decision of designation. Now, in some cases, in many cases, you may have a situation where it's kind of the core business model and how much leverage is used or the kind of derivatives that you're used, and so there hasn't been a delineation. It could be difficult in many cases to do it, but just bottom line for me, I think the clearer that we are at FSOC about what it is that gets you designated and de-designated is a good thing.
The concern that we have, though, is that there's a rubber stamp effect with FSOC with regards to insurance SIFIs. When you have the insurance expert on FSOC say, no, it's not a problem, and yet everybody else goes along with the international designation versus what we think is good for our companies here in this country, it raises some questions and concerns. And so, moving on.
All I would say is I don't think there's not a rubber stamp. It's an independent decision in my view, clearly.
Appreciate the comment. I would venture to disagree with that at this point. Also, SIFI designation for asset managers seems to be headed down that same road. Our asset managers being designated SIFIs headed down that same road. We're very concerned about that as well. FSOC has decided to look at activities and products of asset managers. Does that concern you at all?
I think and again, the FSOC hasn't ruled out designations of asset managers, but I think the pivot, if I can call it that, to products and activities that may raise potential systemic risks makes sense.
Do you believe asset managers are systemically important?
I mean, as phrased that way, I don't think the business model in general creates that. I do think, and it doesn't, and it's not confined to asset managers. Securities lending is one of the activities being looked at.
My question, I guess, is the business model of asset managers, do you believe it can be systemically important?
if it's as a business model, it's an agency model, and therefore, I think that ordinarily it would not be.
Interesting. I see my time's about up. I yield back. Thank you, Mr. Chairman.
Gentleman yields back. The chair now recognizes the gentleman from Massachusetts, Mr. Capuano, for 5 minutes.
Thank you, Mr. Chairman. Thank you, Madam Chair, for being here. Madam Chair, in the last, 20 years, do you know which issue at the SEC has received the most comments of any?
You're probably going to tell me political contributions.
I'm not going to tell you anything.
I don't know. I don't know the answer to that.
That's my understanding, is political contributions has received over 1 million comments.
It has received over 1 million, and I think 2,000 of those are unique. So that's a lot of comments.
Right.
No question.
That being the case, I'm asking, do you plan on addressing that issue in the foreseeable future?
Essentially, and I know we had this conversation last time as well, very strong views on both sides of this issue. I think I have three fairly recent outstanding letters from members of this committee, 2 different letters, and some members in the Senate as well. I'll be responding to those. But as I've said before, our focus is on, and our regulatory agenda focuses on congressional mandates and what I consider to be mission-critical initiatives. Asset management, I've mentioned the disclosure effectiveness, equity market structure.
disclosure
but I do
effectiveness
want to
review-
make clear there are avenues through the SEC's rules, which is the shareholder proposal route, to raise these issues. And they are raised quite actively, and the staff
They are raised,
essentially
but
doesn't permit
They are
exclusion
raised,
of
but
them.
they are not required by the SEC. or
There's
by-
not a mandatory disclosure
So
rule. No,
therefore,
sir.
voluntary, which is great. There are some people that are good citizens that like to tell people what they're doing, but there are a lot who are not.
And companies are voluntarily making those
I
disclosures
applaud
more and
those who
more.
have done it voluntarily. No regulation is done because everybody does voluntarily. Regulations, all regulations on every group is done because there's always a handful of people who are not good players. Regulations are not targeted at everybody because everybody's a bad player. All regulations, including the SEC regulations, are targeted because there's always a handful of bad ones. The fact you have some voluntary compliance, that's good, and I applaud them. Nonetheless, you have many that are not. And, you say, obviously, and I think I appreciate the fact that you clarified, that you're trying to, focus on congressionally mandated ones, but your disclosure effectiveness review generated, I believe, 64 comment letters. 64 versus 1.2 million. And by the way, as I understand it, of those 64, 10 of them related to corporate political disclosures. So,
I
Madam
think
Chair, I would
we'll
suggest-
undoubtedly get more comment letters as the disclosure effectiveness proceeds, but at least a couple of those letters that, you're right, were submitted on political contributions in connection with that initiative also urge us to focus first on our congressional mandates.
Well, clearly, I think America has spoken in every capacity they can to you and to your organization that they want to prioritize this. It's not that difficult. It's not that difficult. And the fact that you refuse to do it just kind of raises lots of questions to me. But you also say you want to focus on congressionally mandated ones. What about Dodd-Frank Section 956A? You haven't focused on that?
The incentive compensation rules.
Yes.
The incentive compensation rules is a joint rulemaking with our fellow regulators, and we're very actively, there's been a proposal some time ago before I even got to the commission.
2011.
And, correct? And we are all working on it very, very actively as we speak.
2011, 2015, almost 2016, and you think that's active?
I'm describing the current state of affairs. We're working on it very actively. SEC is participating in it very
And do you
actively.
think you might have a final response?
We're working very hard to come together on that in the very near future.
In the very near future?
In the very near future.
Is your definition of the very near future the same as mine?
I don't know. I don't know. But it is the very near future, nevertheless.
Well, Madam Chair, those are two issues that one of which is congressionally mandated. And by the way, it said 9 months after passage. You did have a proposal. Your predecessor had a proposal in 2011. As normal, it went back. Since 2014, the other regulators have come up with a conclusion. It's the SEC that's holding them.
No, actually, all the regulators are working on this jointly, and we're covering sort of the entire swath of different registrants, different kinds of registrants. It's quite complicated, but it's all of us working on this together.
I
It's not the
understand it's
SEC
complicated,
holding
but
anything up.
First of all, it is not complicated to simply require political spending to be disclosed. That's relatively simple. If you and your staff can't do it, let me know. I'll have it for you in a week. It is relatively simple. As far as the compensation, I want to be real clear. It only applies to companies with assets over $1 billion. That's all it does. It doesn't say how much. Pay anybody you want, any amount you want. We simply want to make sure that the incentives don't encourage companies to endanger this economy again. That's all it is.
Oh, absolutely, absolutely. That's all it is, although how you bring that about so it'll be effective is not so easy.
Well, I understand that, but
Yeah.
something is always better than nothing, and my time is run out. Thank you, Mr. Chairman. Thank you, Madam Chair.
Time of the gentleman has expired. The chair now recognizes the gentleman from Michigan, Mr. Huizinga, Chairman of the Monetary Policy and Trade Subcommittee.
Right here, Chair White.
I never could find you.
Yeah, I know. It's the new construction. We're about a mile away. So, a couple of things. Actually, the seat that you occupy today, yesterday was filled by Minister Avedo Mena, who is the Minister of Mines for Rwanda, and we had a hearing on conflict minerals 1502. He was accompanied by the Ambassador Matilda Mukanatabana. Very concerned about the effects of conflict minerals in 1502, what it is having on Central Africa. And as you may recall, it's not just the DRC, the Democratic Republic of Congo. There's 9 other countries that are covered by this. As he put it, it's not a conflict minerals boycott, but rather an African boycott, the way that 1502 has been implemented. And you had said so yourself. I'll spare you the whole regurgitation of your own speech from October of 2013. But you said, quote, "But as the chair of the SEC, I must question as a policy matter using the federal securities laws and the SEC's powers of mandatory disclosure to accomplish these goals," referencing the goals of which I think we all share, and certainly you and I do share, of making sure that the laudable goals of reducing conflict, keeping extortion out of the marketplace, and those kinds of things is very true. There was a letter that we had asked for, along with Chairman Hensarling, Chairman Royce, and Subcommittee Chairman Garrett sent you on February 25. Your response letter stated at the time, the period of July of 2010 through middle of March of 2015, this year, the SEC had spent over 21,000 hours and approximately $2.7 million on this particular provision, which I think we agree the SEC has little or no experience with. The hearing brought really 2 questions to mind for me. First and foremost, is 1502 really truly achieving the objectives that I think many of us agree on of helping the people of Central Africa, giving them a better life and a better opportunity. I will tell you that Minister Omena does not believe that is the case. They are investing more money into compliance than what their entire budget is for going out and exploring new mining possibilities. So the Washington Post had said that they did a story on the conflict minerals rule, saying it's well-intentioned but, quote, set off a chain of events that has propelled millions of Congolese miners and their families deeper into poverty. So that's one issue. The second is SEC the right agency to pursue and enforce these rules in light of all of the other important investor protection actions that do fall under your mandate? And my friend, I just see he's left, but my colleague from Massachusetts, who was just beating you up about 956A, that has been waiting action since 2011. Resource extraction, CEO pay ratio, disclosure rules, all these other things that have had time and attention, but are not doing anything to make sure that investors are protected. I really am struggling with how this is an important element to you when we are seeing, and I understand you're being mandated to do these things, but we're seeing faster action on those than we are on 956A or on so many other areas that we need to have that regulation. So please help me understand.
First, that rule was proposed before I got here, so some of those, some of the history.
I fully
understand.
understand.
I'm not trying to.
You're implementing what has
early
been
history.
given
I don't
to
know, but I believe it contained also a deadline where some of the others may or may not. But that's just a fact. I mean, I think to some degree, kind of in both directions. I sometimes get at cross purposes because of my view of correct congressional mandates, which is I do believe we have to carry them out. and to do it in the most cost-effective way as we can. In terms of sort of what's in the queue when, you know, you can do some prioritizing, but it's also, what I did when I first got here was, because we had a lot in the queue, was to try to get separate work streams going. And so, for example, the 956 rulemaking is not done by the corporation finance division as this one is, but separate work streams, and so as they're ready, we proceed with them. We do them as well as we can. Some of the time and dollars are really because we have to be true to the statutory, you know, prescription, and to do it as well as we can.
I understand. In my last remaining 5 seconds, we've seen the SEC budget increase 35% since 2010, 64% since 2005, 300% since 2000. And I hope you are hearing from me and my other colleagues on both sides of the aisle is we need to have priorities. And we may not be having to increase budgets if we would focus in on what your core mandate is. And that's what I want to encourage you to do today.
Time of the gentleman has expired. The chair now recognizes the gentleman from Missouri, Mr. Clay, ranking member of our Financial Institutions Subcommittee.
Thank you, Mr. Chairman, and thank you, Madam Chair, for attending today. And in fairness to the SEC's budget, it does not contribute to the deficit of this country. Is that correct?
That's correct. It's deficit neutral.
You know, and let's stay on budget. The House and Senate Appropriations Committee's marks for the SEC's FY16 budget represent level funding, ignoring yours and the President's request for substantial increases. Please describe what would be the effect of the SEC of level funding in FY16? What initiatives would you not be able to pursue?
I think any number of initiatives. And I think when we're talking about budget in terms of budget increases over time, we also have to look at what's happened to our spaces of responsibility, both the new spaces like crowdfunding and other areas, but also the complexity of the markets and how much they've grown. And so what you see in our budget, and I do try to do this very carefully, is to prioritize, you know, our core mission. We have a lot of core missions because that's the nature of the SEC. So there are a number of things that we could not proceed with. If, you know, under the current CR, for example, we are essentially, you know, in a hiring freeze, which means that just as we need to expand to cover crowdfunding, for example, you know, we can't, you know, we can't get those skilled personnel that are so important to our initiative. It'll hurt enforcement, it'll hurt exams, it'll hurt our IT development and enhancements, which is so critical to us being an effective regulator.
And how does your budget compare to the industry you are regulating? Has it kept pace with the growth in the financial services industry?
I mean, we're outmatched, no question about it. I mean, I think one metric that I think sort of makes the point very dramatically is that it's been reported that 6 of our largest registrants spend about $10 billion a year on technology. You know, our entire budget is $1.5 billion.
And at this time, and you mentioned crowdfunding, do you expect to need additional resources to oversee these new entities?
Yes, we have to build out that entire regime as well as municipal advisors and others.
Thank you, Madam Chair. And at this time, Mr. Chair, I'd like to yield the remainder of my time to the gentleman from Massachusetts.
Thank you. Thank the gentleman from Missouri. Madam Chair, thank you for being here. I know that the ranking member spoke earlier in the hearing about the WIXI waivers, and I know you made some comments recently regarding that. The idea, though, the basic idea here is that we would reward good behavior with a WIXI title or label, well-known, seasoned investor, and also allowing them off-the-shelf registration, and yet we would withdraw that privilege if we had felony conviction or you know, securities fraud on the part of these companies. And so what we have seen here repeatedly, I must say, from the SEC is that even though they're convicted of felonies, even though they're convicted of securities fraud, we let them have that privilege. We don't discourage bad behavior. And so I'm just asking you to try to explain that, because I read your statement, but it's confounding to me.
And again, I've tried to lay this out, and I made a speech, I think, last March on this to
Right,
try to
I read it.
be as clear as one could be. But first of all, I think we're all about trying to punish bad behavior, and particularly financial institutions and senior executives who've committed wrongdoing. And I think our record enforcement is quite aggressive and quite impressive. I think in terms of WICSE, I mean, essentially that was part of offering reform that had a somewhat different, more streamlined set of procedures, if I can call it that, for well-known seasoned issuers, not just financial institutions, it can be manufacturing companies, et cetera. In addition to streamlining, it also provides more information real time to investors. That's kind of the WICSE regime. In terms of, if a company is indicted or commits securities fraud or some other trigger for being disqualified as a WICSE. And again, this is covered by regulation or statute with respect to all disqualifications. Then what we also have covered by statute or regulation is a procedure for granting a waiver, putting the burden on the party seeking the waiver. And in terms of the WICSE, what you're looking most closely at is going forward, can this entity can you rely on their disclosures going forward, the reliability of their disclosures? So if the trigger happens to be
my time has expired. Here's what I'm saying is, a conviction for fraud, a conviction for a felony, that's reason to be less that hurts the reliability of these companies, and they should have that title withdrawn from them. That's my argument.
Time of the gentleman has expired. The chair now recognizes the gentleman from Wisconsin, Mr. Duffy, chair of our Oversight and Investigations Subcommittee.
Thank you, Mr. Chairman, and welcome, Chair White. It's great to have you back. We talked privately, and I've seen the press release from the SEC in regard to the tick size pilot program. You have implemented a 5-month delay. We've talked about that. This is not going to be a death by 1,000 delays, is it? You're still committed to implementing the pilot program?
Totally committed to it, totally committed to it. We want to get it right, though, so it'll be meaningful, obviously. That's the goal. And we thought long and hard about it. We calibrated the extension so that we could get good, reliable data, so we get the results we're hoping for from the tick size pilot. Totally committed to going forward with it.
And we want good data as well, and to make sure the pilot program is set up correctly, a little more time isn't met with a big objection from us, just as long as you're still committed to implementing the pilot program. So thank you for that. I want to follow up on the chairman's question in regard to the corporate bond liquidity and its relationship to the Volcker rule. We think there's a great tie-in to economic growth and job creation through the corporate bond market. And I think you indicated today and in your last testimony that you don't see a correlation between the Volcker rule and the lack of liquidity in the corporate bond market. Is that correct?
That has been the conclusion of each of the joint agencies, including ours, quarterly reports to this committee. In terms of not being able, certainly, to determine that it is, I think is a better way to say it, perhaps.
Let me be clear first. You would agree there is a liquidity issue in the corporate bond market,
well,
yes?
I agree that there is a concern, yes. I mean, I think we try to give in each quarterly report exactly what we're seeing in the liquidity, and sometimes it's quite strong, and sometimes it's, it's somewhat more volatile, but clearly close eye on it and a concern.
So if not the Volcker rule, then what? What is causing the lack of liquidity? I mean, you have to ask the question, and it has to be a concern for you. What's causing it?
Well, again, I think you have to look at whatever particular market we're talking about at a particular point in time and what is the liquidity, because sometimes there'll be talk about the lack of liquidity and it's quite robust at that time. So that's why in those reports we do both, here's what we're seeing in the primary markets, here's what we're seeing in the secondary markets, and then also try to analyze what is having an impact on that. Everybody keeping very close eye on, the diminution of liquidity, which would be very, of great concern to everybody.
And it would.
But ferreting out impacts is not easy in that space.
Right. There's great liquidity, but you hit a bump in the road, and all of a sudden liquidity vanishes. I think that's the cause for concern. And so you can say, yeah, sometimes there's great liquidity. That's true, but we care more about those little bumps that liquidity vanishes. And I think a lot of us would argue that the liquidity issue has arisen with Volcker and Basel and all the rules and regulations that have come to pass. And I don't know if you don't want to share your personal opinion because it might be contrary to the position of FSOC. I get that, but
No, it's not. It's not that. I really do, bore into this with our own staff too, because I mean, one thing that we do for every single rulemaking we do is to try to judge those impacts.
And I would argue that there's people on the outside, per the questions by the chairman, have some significant disagreement. I want to go to I only have a little bit of time left. I want to make just a quick comment in regard to the corporate political spending. Obviously, I get a lot of letters as well. I know that people rally folks up around the country, whether they're on the right or the left, to send me letters. I'm sure you get the same, and you know where those letters come from. There's a political agenda. But for a corporate political spending disclosure, would that protect investors if you did a rule to that effect? Would that be material to the decisions investors make?
I mean, that may be to some degree, I suppose, the eye of the beholder. But I mean, clearly, if you're looking for, what's material to investors, I mean, under current law, in the particular context of a particular company, could be level of spending or something else unique about a company. If it's material now, it has to be disclosed. What is being sought is a mandatory disclosure rule.
Right.
Across the boards.
I would agree. This isn't material in regard to investment decisions that are made. This is politics. Politics are coming at play, and they're trying to send a whole bunch of letters to you, so we can find out how corporations might give politically, and they can rally protests and sit-ins, and we know how the game works. But I would encourage you to push back and keep a sound, steady course. Want to quickly pivot. We had the Director of Investment Management, David Grimm, into the committee. I don't know if you watched that testimony, but we talked to him about the systemic risk of asset managers and how FSOC had actually used your team and his team to get insight. And I didn't feel very confident that the expertise within the SEC has been tapped by FSOC. And it gives me concern that we have FSOC making decisions that are contrary to those experts in the field, say at the SEC with asset managers. Also, as Mr. Lutemeyer brought up, Mr. Woodall voted against MetLife and others, and those who don't have that expertise are voting to designate. So we do have some, and I know my time is up.
I would just say that the staff is providing extensive expertise to FSOC on the subject of asset managers, as in terms of, for example, the request for information that went out in December. I mean, that's quite active, and it's very important that we do provide that expertise. I think it's being received.
I didn't feel very confident through Mr. Grimm's testimony. I would yield back.
Time of the gentleman has expired. Chair now recognizes the gentleman from Massachusetts, Mr. Lynch.
Thank you, Mr. Chairman, and thank you again, Madam Chair, for being here. I'd like to revisit a topic that Ms. Maloney from New York raised earlier today, and that is going back to the August 24th problems in the market. I realize that at that time, the markets, our markets, U.S. markets, were responding to a sell-off of Chinese stocks earlier in the day. However, according to the Wall Street Journal, there were dozens of exchange-traded funds that traded at sharp discounts to their net asset value or their component value, and leading to outsized losses for investors. And I know your opinion was that the markets worked very well, but there are some retail investors here who are very upset. Do we have any sense of how much money retail investors lost on the 24th of August?
I mean, they're, not as a net figure, I think, because, and particularly if you're trying to tie it to...
Ballpark?
We'd have to get back to you with whatever we could do on that. But with respect to ETFs themselves, I mean, clearly, you worry about retail investors in whatever spaces they're in, and they're obviously in ETF spaces. One of the interesting things that, and I think it'll come out in our initial results when they're made public, is that why some ETFs with kind of the same characteristics didn't have that phenomenon occur and others did.
Right.
But clearly, we're looking very closely at it.
Reclaiming my time.
Sorry.
I know that we have a couple of indicia here, I guess. The Vanguard Consumer Staples ETF and the $5.8 billion Vanguard Healthcare ETF both plunged 32%. within the opening minutes of trading. And yet, if you look at the component stocks within those baskets, they were only down about 9%. So what was also troubling, at the same time, the VIX, the CBOE volatility index went dark. So for that first half hour, it didn't come on till 10 o'clock, and people didn't know, how much fear was in the market or what direction things were going in. So that was a problem. And this is all in a time when the Dow experienced its largest point drop in history. And so a couple of questions I have of this. Again, I ask you, how much was the loss for retail investors? And I appreciate you if you can get back to me on that. But given the fact that the whole idea of ETFs was to respond to the flash crash and the lack of liquidity so people could actually trade. We have examples of, I think there were 37, in the first 37 minutes, there were, I think, 1,300 stops and instituted on individual stocks. And
I think that number covers the ETFs as well. Yeah.
Yeah. How can we prevent this problem? Because we're going to have sell-offs in China again at some point.
Again, not commenting on the cause or causes of, August 24th, but the thing, what you're referencing now, at least primarily, I think, is the limit up, limit down mechanism put in after the flash crash. And that's precisely what we're, studying based on that data that was generated on August 24th and how to recalibrate that to make it more effective. I mean, the circuit breakers actually weren't triggered. Yeah.
Why the delta in the component stocks versus the ETFs? Why?
That's exactly what we're looking at. In other words, but it's not as simple as an analysis because you'll have the other ETFs with the same characteristics that didn't experience those trading pauses. So why is that? And that's one of the things we're analyzing as well. And as I say, this will be an ongoing study, but I'm hoping in the pretty near future we'll be able to share some results that will answer some of the questions.
Yeah. Do you know if in the beginning, and you talked about the opening, that was the real problem. Do you have any correlation, at least evidence that high-frequency traders jumped on this in the early opening?
I mean, again, we should wait for the initial results because we're analyzing everything, but that doesn't pop out.
Okay. All right. I thank you, and I yield back.
Gentleman yields back. The chair now recognizes the gentleman from Pennsylvania, Mr. Fitzpatrick.
Thank the chair for the recognition, and Madam Chair, thanks for your testimony here today. When members of Congress, when we listen to our constituents, we learn a lot about the economy, about what's holding it back, what the problems are with job growth in the country. 4, 5, 6 years ago, what I used to hear from my constituents, high health care costs, high taxes, a lot of uncertainty in the tax code. I have to say over the course of the last 2 years or so, the focus has shifted dramatically and almost exclusively the cost of regulation. Last week I was back home in Bucks County, Pennsylvania. I met with a constituent whose clients are banks, and he talked about this one particular new startup, about 10, 12 years old. I think there are less than 50 employees in the bank. He said 8 of them were compliance individuals, complying with regulation. I have to say, even, much as we pay attention, I was shocked at the numbers. And those banks would tell us, these are individuals that are not able to be processing loans, meeting with customers. Last night I met with a constituent, not in the financial services industry, different industry, but the same issue. And he was emphatic at the cost of regulation and what it was doing to his particular industry. In my community, Bucks County, Pennsylvania, we have a lot of high-tech, biotechnology firms, startups, investors taking big risks for them. About 3 years ago, one of my constituents, a representative from a pharmaceutical company, employs many constituents. His name's Jeff Hatfield. He testified before our subcommittee on capital markets, and I've got his testimony here. And what he was testifying on was the cost of regulatory compliance, the negative impact on research, hiring, and potential growth. Specifically, one remedy that he cited was the filing status classification 12B2 to encourage growth but also protect investors. As I'm sure you're aware, biotech companies may research new therapies for years at a great cost without seeing an actual profit, despite a lot of market valuation. They're still required to comply with all the regulatory requirements. He was talking about 12b-2. I think he also testified about 404b, which is a section of Sarbanes-Oxley that requires an awful lot of sort of external audits of internal controls. The SEC, I'm sure, is looking at this. What are your thoughts on what Jeff Hatfield testified before the committee and whether or not this cost is really dragging down innovation and hiring in the communities?
I mean, what we do at the SEC, I mean, is really quite vigorous cost-benefit analysis. I mean, that's of all of our rules. I mean, and, you know, I think one of the great success stories at the SEC, frankly, is our DERA unit, you know, our economists who actually perform that work and a lot of other work, you know, at the SEC, a lot of studies to try to really calibrate both the baseline, where are we now in terms of what are we trying to accomplish with the regulation, what's the benefit of that, where's the market now, and then if we impose this regulation in this form, what is its cost going to be? And you clearly look at size of company when you do that too. You look at different industries when you do that too. Now, I can't tell you that net comes out, you know, so that there's not, you know, some of those costs imposed, obviously. But what I can say is that the SEC really does, you know, a very thorough analysis of cost-benefit.
Well, in terms of the size of the companies, and a lot of the pharmaceutical and biotech, they don't have a lot of employees. They're highly compensated employees. And they may have a lot of market value, but they're not going to have any revenue for 10 years. It could take $1 billion in research to get a therapy to market with no profit until that point in time. So what does the SEC cost-benefit analysis say about those companies, which are very important in my district because they can't grow. They're spending money hiring external auditors, complying with a rule that I'm sure was well-intentioned, but not intended to be impacting firms like these.
I mean, I don't know how to answer that other than to say that, you know, that our economists, you know, try to look at it not just as here are the compliance costs, but what does it do to, you know, competition? What does it do to, you know, the other economic impacts besides just, and I don't mean to minimize it, but besides just the compliance costs. But again, obviously, what's driving that analysis in the first place is a need, a perceived need, certainly, you know, for some regulation to protect investors, the markets, facilitate capital formation. But, you know, we should be doing as deep a dive as we can, no matter what the industry is, no matter what the complexity or uniqueness, maybe is a better word, you know, and I appreciate that that is how the pharmaceutical R&D works in particular.
Thank you. Yield back.
The gentleman yields back. The chair now recognizes the gentleman from Georgia, Mr. Scott, for 5 minutes.
Thank you very much. Over here, Chair Lady. Chair Lady, are you aware when we wrote Dodd-Frank that in Section 913, we gave exclusive responsibility to the Securities and Exchange Commission if there came a time when we needed to put together a best interest standard for a fiduciary? You're aware of that, aren't you?
I'm certainly aware that 913 gives the SEC authority to proceed, doesn't mandate it, yes.
Well, let me ask you this. Why are you allowing the Labor Department to take over your territory that we put in Dodd-Frank that was approved by the House, approved by the Senate, and signed by the President of the United States?
Well, I don't view it, and I've heard the comments before, I don't view it that way. I mean, I think that, again, we are separate agencies. They do have responsibility in the and statutory authority in the ERISA space. I mean, even as we sit here now, you know, brokers have to comply if they're in the ERISA space with the Department of Labor rules and ours.
Let me respond to that, please. I was here. I helped write Section 913. There was a reason why the Securities and Exchange Commission came to set and let us do this, because they were the regulatory agency. Now, you mentioned ERISA. Not once, not one time did the Labor Department come over and said, oh, hold on, let us handle the retirement. No, there was no discussion of that. That is just happening now. This is a critical issue, and if there ever was a time for the Securities and Exchange Commission to stand up and do its duty so that all of the American people can receive the proper financial advice to make those critical decisions. Do you realize what the Labor Department is doing? Do you realize what the position that is putting FINRA and you in as far as complying these complexities? And if you allow and sit back and disavow the authority we put into 913, that would be a very, very serious indictment on the Securities and Exchange Commission. So what I'm asking you, and this is why, when you allow and you pass a rule that says that instead of a commission base, that now you have to pay upfront, fee for service, out of pocket, before a financial investor can even talk to you about it. That has a clear disproportionate impact on the lower income, the middle income, and especially African American investors and other minorities, because they don't have that much. And when you get to what they basically do, even if you get to the annuities, which is what they really utilize, but you have three different ones. You have the fixed annuity, the variable annuity, the index annuity. That in and of itself is enough to run most people away. And then if they go through that, then they got to sign a contract. Now, I tell you, Ms. White, I want to ask for you to get more aggressive here. And because you are going to be placed in the middle, FINRA is going to place in the middle. And if they had this unworkable best interest contract exemption, it would result in low and middle income people being pushed from these less expensive commission-based accounts to the more costly fee-based upfront out-of-pocket accounts. How do you see FINRA managing this conflicting compliance obligation? Because under current regulations, FINRA must find costs to be a pivotal issue when assessing and making the difference between what is best here. Our financial system is complex and complicated, and you are going to push out lower and middle income people from being able to invest with their retirement. I have great respect for you, and I want you to make it plain. Seize your authority back on this fiduciary issue. The Labor Department should have said, if we got a retirement, it's written in the Dodd-Frank that the SEC has its responsibility. The respectful thing for them to do is at least come to you and FINRA and say, let's work and harmonize something to address this. This is not their bailiwick alone. And I'm speaking for an awful lot of very, very important people, the low income, the middle income, and most African Americans. They need you to stand up on this.
Time of the gentleman has expired. The chair now recognizes the gentleman from Georgia, Mr. Westmoreland.
Thank you, Mr. Chairman. And thank you, Chair White, for being here. Chair, you realize that some of the things that we're responsible for is trying to help our constituents solve problems. And I've got one that I would very much like for you to address on his behalf. Do you know what a naked option stress analysis is, or an NOSA?
I do now, I believe. I think your staff indicated you had this issue with the constituent.
Yes.
I knew before, too, but I know more now than I knew you had the question.
You and I both know more about it than what we used to. And my constituent is very, very aware of it, and he has been quite successful in his career. And the NOSA is a proprietary algorithm created by Merrill Lynch to mitigate risk from naked options trading. And when it's triggered, the account holder must post a NOSA margin to cover potential losses. And my constituent has contacted me, and we have been over and over and over with the SEC and Merrill Lynch and others trying to find out what triggered this call. And he has been unable to get that resolved. And even though he has asked Merrill Lynch on several occasions to give him that, they said that that is a resource that they have trademarked. Now, do you think it's necessary? I mean, do you think it's okay that a company like Merrill Lynch could patent something to use on their investors and not be able to tell them what that is?
Is this on? Yeah,
Microphone.
it is. Sorry. Is it on? Okay, sorry. I don't want to speak about the specifics till I know all of the specifics, but clearly there are, a number of obligations with respect to this. Disclosure obligations, suitability obligations. What I would suggest on this is that and it sounds like you've been talking to the SEC. I don't know who at the SEC, but if I could have one of my senior staff people follow up with your staff member, let's see if we can get to the bottom of it.
Well, I appreciate that, Chair White, and I've got a pretty good file here that we'll get to your staff before you go, but it would certainly be something good because this gentleman has jumped through all the hoops and done everything, he and his wife both, to get an answer and been unable to do that. And so any help that you could give us as far as getting an answer or a conclusion to this, it'd be much appreciated by me and Mr. and Mrs. Denny. So thank you very, very much. Now yield back.
Thank you.
Gentleman yields back. Chair now recognizes the gentleman from Texas, Mr. Green, ranking member of our Oversight and Investigation Subcommittee.
Thank you, Mr. Chairman, and thank you, Madam Chair, for appearing today. Madam Chair, I'd like to get some things for the record. These are things that are of common knowledge to a certain extent. It is true that you're a member of FSOC, correct?
Yes.
And as a member of FSOC, you have voting privileges.
Yes.
And as a member of FSOC, which is a newly formed institution as a result of Dodd-Frank, you have the ability to look at the entire financial system, looking for risk that may be out there that can hurt the system. Is that correct?
Yes.
Simple terms. Now, in doing this, Madam Chair, would it be fair to say that if we had had FSOC prior to 2008, we would have been more likely to see the concerns that AIG posed than less likely to see them? Is it fair to say that there's a greater likelihood we would have seen some of these concerns with AIG?
It's always hard to judge that, obviously, and you see what you see, but this is a mechanism that's enormously important to seeing, risks as early as possible because you've got, all of the relevant financial regulators or a good component of the financial regulators from different strata in a room together talking about what they're seeing. And there's no real substitute for sort of identifying a problem early than that, I think.
Well, this is why I ask in terms of more likely or less likely. More likely to have seen it or less likely?
I mean, certainly in theory, it should be more likely.
All right. And in reviewing entities such as AIG, which had this London office that was doing some things that we didn't find quite acceptable after the fact, in reviewing these things, do you spend an inordinate amount of time looking at entities that don't come under the $50 billion threshold as a trigger for designation as a SIFI? Do you spend a lot of time before you cast that vote?
You spend a lot of time before you cast the vote, a lot of time.
And do you have an office to help you with research, OFR, to help you with the research? People who provide expertise to the Treasury, and the Treasury can share its
and certainly OFR does research on various issues. The FSOC staff and the staffs of the member agencies also do a lot of work.
Thank you. And when you cast your vote, are you told how to vote? Does someone say to you, you have to vote a certain way on these issues?
No.
Is it your opinion that you've been a pretty independent person serving on this FSOC?
Yes.
And as an independent person, you put your time in and you study things, and you come to final conclusions.
Yes, and I study it with not only the FSOC staff, but our staff.
Now, I just looked at some of the information on some of the very large companies in this country. A good many of them have triggers that bring them under the auspices of FSOC and the SIFI designation. If you had to study every one of them to ascertain whether or not it should be a SIFI, would it take a lot of time to do this?
No question.
Do you have the personnel such that you could study all of these mega corporations that are 50 billion and above? Do you have the personnel to look at them with the kind of detail that you need if you did not have the trigger to bring some of them under an umbrella?
Well, I mean, obviously the resources are finite. I mean, you try to prioritize the ones that pose potentially a systemic risk.
And do you find that it's beneficial to have a trigger, whether it's at 50 billion or some other amount? Is it beneficial to have a trigger?
That's a little hard to judge because obviously what we're presented with are, those that have met that trigger. So you don't know what hasn't met that trigger, I guess, to some degree, but logically, yes.
And without that trigger, would you find yourself having to answer a good many more MetLife questions and a good many more questions that relate to entities that you're trying to sift through and ascertain whether or not they're SIFIs?
I think it would depend on what substitute methodology you had.
Okay, thank you very much. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from California, Mr. Royce, Chairman of the House Foreign Affairs Committee.
Thank you, Mr. Chairman, very much. And Chair White, thank you. If we look back to the collapse of Lehman Brothers, one of the lessons was the need to quickly understand the relationship of corporate entities to one another. And so out of the ashes of Lehman's downfall came the Financial Stability Board's concept, and this was actually at the direction of the G20, this concept of legal entity identifiers, or LEIs as we call them, where each entity has to register that unique 20-digit code. And that makes their identity very clear when you're trying to unravel something in real time in terms of all their financial transactions. So last month, this committee passed out legislation, which I authored, requiring the Office of Financial Research to provide an annual update on the progress of adoption of these LEIs here in the United States. Now, the global adoption, I think, is at 400,000 LEIs now in 180 countries. So if the OFR were to conduct its report today, I'm afraid that the SEC would lag behind a bit in terms of the adoption in other countries. As we move towards more transparency, this obviously is part of our mission. And I think the Commission did mandate the use of LEIs in its security-based swap rules. It didn't require it in other rules. So I guess I'd ask, should we expect that the SEC is going to require greater use of this important risk management tool in the future? And is there anything holding you back in that regard?
There's nothing holding us back. Obviously, if it's appropriate to the space, you want to make sure it's, it fits, right? But I think, look, I think LEI is an enormously important tool. The SEC has been a very strong proponent in those global efforts that you mentioned, and we frankly we're looking for, opportunities to use it more, I guess is the way I would answer your question.
But to get to that point, you might promulgate more rules in that direction in order to increase the adoption where appropriate.
Essentially, as we are adopting whatever rules as we go forward, we would look for that opportunity.
Right. Let me ask you another question, Chair White, and that goes to the Financial Services Committee's focus here under the chairman. What we've been trying to do under the chairman's leadership is to take a strong interest in housing finance reform and see how we can move forward the concept of bringing more private sector credit risk sharing into the GSEs. We'd like to get as many positive things done as we possibly can in this quarter. So real estate investment trusts are a logical investor in these transactions. We've seen the communication from the FHFA that say that it does not perceive any drawbacks from greater involvement by REITs in credit risk transfers. This might be an area that sooner rather than later we can move forward additional steps to get more private capital. Could you work with us to clarify that all of these risk transfer deals are viewed as good REIT assets that do not undermine investor protections?
Certainly be happy to work with you on that, and have the staff, I think the staff may be working with you on that, but I'll make sure that they are.
I think that would be helpful. I think it's very clear that, you know, as the Federal Housing Finance Agency says, at the end of the day, there's a clear benefit in getting credit risk transfers, to, you know, get more private capital back in here for this part of this equation, and that REITs can do this according to them, according to us. We certainly see the benefit to this, and it's when you're looking at a significant source of private capital like this, it just doesn't make sense to, just because of regulatory hurdles, prevent that capital from being deployed. So we'd appreciate that assistance.
Gentleman yield back.
Thank you, Mr. Chairman.
Gentleman yields back. Chair now recognizes the gentleman from Washington, Mr. Heck.
Thank you very much, Mr. Chair. And Madam Chair, thank you so very much for being here. I want to ask you about the Volcker Rule, which I consider to be fairly important. Of course, the rule is final, but it's not yet being enforced, and is at the end of the day, I guess, rather a bit of an experiment. So I want to pick your brain a little bit about it as we await the time when it's actually implemented. So what are you seeing in terms of market behavior and anticipation of the effective date? How do you see the market changing? How do you see companies adapting to it? And do you yet perceive any change in the risk being taken in the risk to the financial system? Just talk generally about those kinds of things. Is that?
You know, again, it's a little hard to judge at this juncture, you know, certainly with any definitiveness on that. I mean, we're basically just about now going into the exam for compliance period, actually. And all the agencies are, and we're coordinating well. We'll learn more from that, but before that period actually kicked in, we were obviously, you know, talking to those subject to the rule to see if they, you know, were they able to provide the metrics they needed to comply, and really, I think, got a very, you know, at least initial, you know, positive read on that. I mean, obviously.
What does positive read mean?
Well, positive read meaning that they should be able to comply, okay. You know, in a timely way. Now, you know, obviously, there are exemptions in the Volcker Rule and there are prohibitions in the Volcker Rule, and compliance is really at the trading desk level, and so there's a lot to look at in terms of, is this market making, is this, you know, or is this something that's prohibited? So, you know, I think we have to see what comes out of certainly this first wave of exams to see, hey, is it working, is there good compliance, and then in terms of judging its effects, I think that's down the road a bit.
But where you sit here today, based on what you know, and given that it is limited, are you confident that it will, in fact, reduce risk to the financial system?
That is certainly the objective, which is, you know, basically to not have these institutions that are connected elsewhere engage in, you know, proprietary transactions. But, you know, again, I'm a person who sort of waits on the data, but I think, you know, that is certainly the purpose.
It is the purpose. Are you confident that it will achieve the purpose in large part?
I have to see the data, I'm afraid, on that. Okay.
All right. Subject 2. You're also currently reviewing a change in definition for accredited investors. Your predecessor was pretty clear that it very much needed to be changed and updated. So I'd like to ask you what the status of your review of the definition of accredited investor is, just a general timeline for you think that where that work will end up, what you personally think the direction needs to be.
I mean, sorry. Did you
Sure,
finish? Yeah.
no.
First, clearly it, for a while needed a real deep dive look in terms of all the various criteria that need to be considered, not just net worth and income levels, but including them. Our staff has, been, studying that quite intensively for some time, and they really are coming to a conclusion of their work. And the next step, I mean, really quite in the last phases of that. And the next step, which I think will be relatively soon, I know you want me to define that next, but relatively soon, to basically, put out publicly what those findings are and what the analysis is.
Is relatively soon something like 90 to 120 days?
I would think so.
And do you personally believe that there is a definitive need to update?
I do believe there's a definitive need to update. I can say that much, yes.
Can you give an example of the kind of change that you think?
Well, I don't want to get, again, we'll have to decide this, so I don't want to get ahead of, and we're a 5-person commission also. But clearly what we're looking at beyond the traditional tests of net worth and income, are other kinds of sophistication, experience, qualifications that certainly many would argue should entitle you to be an accredited investor. And I think one wants to be sophisticated about and realistic about what those other criteria are that would meet, any investor protection concerns, frankly. So we're looking quite broadly.
Thank you. With that, I yield back the balance of my time, Mr. Chair.
Gentleman yields back. Chair now recognizes the gentleman from Virginia, Mr. Hurt.
Thank you, Mr. Chairman, and I thank the Chair for appearing before us today. In your testimony, you touched on equity market structure. I wanted to highlight one of the things that you said. You said that you all have been proceeding since your last visit here with an ongoing assessment of the U.S. equity market structure to ensure that our markets remain the deepest and fairest in the world and optimally serve investors and companies of all sizes seeking to raise capital. I wanted to turn your attention to the National Market System Plans, NMS plans that were created in 1975 as an amendment to the Securities and Exchange Act 40 years ago, and obviously a lot of things have changed since that time. The U.S. equity exchanges at that time were not-for-profit. They were member-owned. Today, of course, they're publicly traded and they are for-profit, and so a lot has changed in the last 40 years. When you talk about plans for the collection dissemination of market data, I think that we would all agree that if you want to ensure the deepest and fairest markets in the world and optimally serve our investors, you have to have accurate market data, and that's got to be collected and disseminated in a fair and accurate way. In the aftermath of the NASDAQ SIP outage in August 2013, I think there were some concerns that were raised about the governance of these NMS plans. We know that the NMS plan participants are exclusively representatives of the exchanges and FINRA with no industry representation. And that leads, it has been argued to two separate problems. One is that you don't have a broad-based representation among these participants in providing the best sort of leadership and vision for what needs to take place in making sure that these SIPs are the best that they can be. And then secondly, and perhaps more of greater concern, is the conflict of interest issue. And that has, of course, to do with the fact that that because of the way the revenue is shared, that that there is a disincentive to invest in the SIPs to make them as good as they should be. And also the secondary issue relating to a conflict of interest has to do with the fact that these exchanges have their own data feeds that compete with the SIPs information. So I was wondering if you could talk a little bit about where you are, what you think should be done as it relates to the reforming the governance of these NMS plans.
Yeah, I think that, and this is one of the reasons that I frankly sort of identified this very deep, comprehensive review of NMS and equity market structure, even before I was confirmed as one of the highest priorities. And we've proceeded on that, really in a sense, on two parallel tracks. One, there's some things that, clearly would optimize the markets that we're proceeding on in terms of specific rulemaking, and then the other is really the more comprehensive review that takes into account. And we've obviously spent a lot of time, dealing specifically also with, SIP governance and single point of failure, and enormously important that the SIP provide its information, quickly to the, with the consolidated information. And and I think you can see from our work on the Market Structure Advisory Committee and the subcommittees that we just formed that we're looking very much at that issue, those issues, as well as just kind of the whole role of the, exchanges in the equity market system. We're not, we haven't concluded on those things, but very much front attention.
But can you, as you sit here today, can you explain to me why, what resistance there is, or why we should continue to have these participants that are exclusively from the SROs without including anybody from industry?
I think, I'm not sure I can, provide that answer other than to say that, one of the things we need to make sure that as we are making the changes, the system, continues to function. And I'm not suggesting putting a representative from the industry on there would mean it didn't continue to function, but we're trying to sort of optimize every aspect as we go. So I could probably provide you some further information on that.
Well, I'd appreciate it, and I do think that the conflict of interest issue is something that obviously goes to the fundamental fairness issue that I think that we all want to see in our markets. Thank you. I yield back.
Gentleman yields back. The chair now recognizes the gentleman from California, Mr. Sherman.
Thank you. Well, I bring up FASB's $2 trillion addition to the liabilities and assets on American balance sheets each time you're here. I want to commend you for stepping forward in the prior and say, yes, FASB gets their authority from the SEC, and you take responsibility for your decision to delegate that authority. They didn't follow the Administrative Procedure Act. They didn't listen to anybody in the construction field. They didn't do any cost-benefit analysis. And we're going to see a decline in construction employment as a result of this new rule. So I'll just ask you, you take responsibility for all that?
Well, we have had this discussion before, and again, the SEC has ultimate responsibility for accounting standards. We've obviously, for many, many years, recognized the private sector, therefore FASB as the standard setter. And the SEC has the power.
The SEC hasn't required them to follow the Administrative Procedure Act. The SEC has done nothing with regard to their processes or their outcomes.
Well, I can't say they have. I understand your point. From your point of view, they haven't followed their due process procedures. I certainly haven't received that information from any other quarter in terms of the process that they followed.
I do know that that information from whom?
Among others, obviously, people comment on their process publicly all the time, as well as, our staff in the chief accountant's office.
The people who comment live in this world I used to live in, of accounting. They barely heard of the Administrative Procedure Act. It is foreign to that world to let carpenters and pipe fitters come before the agency and say, please don't ruin my family and my job. And so they refuse to listen to any of those people.
Again, information that's coming to me is that FASB, comments were received on this proposal, obviously, several times, and that they were responsive to some and not to others.
They wouldn't. That's why I'm using the word listen rather than the word invite people to send emails that will be thrown away. They wouldn't listen to anyone. They didn't do a cost-benefit analysis. We're going to see a decline in construction jobs. There is no benefit from this.
Of course, an accounting standard is, meant obviously to convey the economic reality of the transaction. And I know we've had this conversation before, but it was actually in 2005 that the SEC staff actually recommended that FASB, undertake in effect,
Right,
capitalization
with
of
no
leases.
cost-benefit analysis, never discussed it with anybody who showers after work rather than before work.
And again, in terms of where cost-benefit analysis comes in or doesn't for an accounting standard because of the purpose, I know you're a CPA, but obviously in a very good one, but it's really to convey the economic reality of the transaction. I know
Yes,
they put off the
look-
transition period, being
Right.
cognizant of
Their
the
the
cost.
transition, they don't convey economic reality in their discussions, which is why they have no defense for FASB number 2, which also distorts the American economy by penalizing companies that engage in research. Every accounting, and I will ask your chief accountant to look at this because it's proof that they don't always do it on the basis of economic reality. Every accounting theorist for decades said that you capitalize research. They don't, because it's not convenient. And to come here and say, well, they just reflect accounting theory and economic reality is a misstatement of what they do. And I know I've brought up with your people FASB number 2, and they basically say, look, we don't want to listen to reality. We don't care. We want to do what's convenient. And this approach, if the same people that tell you that accounting theory, and it doesn't, requires leases to be capitalized, let them cite you any to any accounting theory that says research should be written off and not capitalized. The accountant, you have empowered, you take responsibility for, they give you some talking points. These decisions are as important as any reached in Congress. They affect hundreds of thousands of lives. And the procedure and the outcome is not something that your agency can be proud of. I yield back.
Time of the gentleman has expired. Chair now recognizes the gentleman from South Carolina, Mr. Mulvaney.
I thank the chairman. Thank you, Chair White, for coming in today. A couple of minor deals, and I'm going to talk more than I ordinarily do, just so we can have you understand where we are on a couple different things. Thank you very much, by the way, for offering the proposed regs on crowdfunding. The last time you and I spoke in March, you had gave us your best efforts to get them done by the end of the year, and we appreciate that. I understand they were published the end of last month, the end of October, and they're out now for review. When can we expect those to be implemented on the Jobs Act, the crowdfunding portion of that?
Essentially, I think they become effective in, I want to say, it's in 2016. They're final rules now.
Right.
So it's a matter of the effective date. I think it may be October, but it may be earlier.
Okay, so October of next year or earlier?
Yes, but I think it could be May. I'll have to give you the exact date.
That's fine. That would be great. The only thing that, when I got them, one of the questions I had was, I used to run a small business. There are almost 700 pages, which I suppose on one hand is to be expected, given what we're doing here, which is going out to the retail public, small investors for the first time. So there's a lot of protections that need to be built in. One of my questions, though, on this is how do have y'all talked about how you're going to handle de minimis violations? We've got small mom and pop organizations, that's who this is designed to help, now having to deal with 700 pages full of regs. Have y'all given this much thought at how you're going to reconcile those two things?
Look, the answer is we're not sort of out there to, get people on this. We want this marketplace to work. Obviously, we want investors protected in the marketplace. One of the things that I've done since I've been here on kind of these new marketplaces that we're setting up, whether it's lifting the ban on general solicitation or A+ or crowdfunding, is to have an interdivisional working group kind of all over it when it begins, as opposed to sort of looking at it a year from now, which means as part of that, it's not just enforcement or examination, although it includes that clearly, but it's also Corp Fin and and trading in markets and people that can give guidance and help people conform to the regulations as we go. So hopefully it will be helpful.
And lastly, and just
the effective date, I happen to have it here. Once in a while, I bring a piece of paper. May 16th, 2016.
Beautiful. Thank you for that. Lastly, y'all changed some of the size of the investments for the small retail investors. You took it down to $2,000. Very briefly, could you tell us your thinking on that?
We did take it, again, what we were doing in the crowdfunding space was to try to, we got comments from kind of both directions, which was, this is just not going to be workable, there's not enough, capital, you're sort of shutting people out of the markets, to, we really are concerned about people fraud and people losing money. And so that was one of the adjustments we made in respect to, comments we got, really in direct response to comments we got.
Thank you. I encourage you to keep an open mind. If things work out as we had hoped they would when we passed the bill, that maybe we could review those limits as well as other things with the bill. I want to switch gears now to the Small Business Credit Availability Act that Ms. Waters mentioned in her comments, and I'm going to speak more than I'm going to ask here, just to let you know where we're coming from on a couple of different things. I've sort of participated in this bill. So we're talking now about BDCs. We've got your most recent letter from early November. We've gone through it, and we're very excited about working with you to get the SEC okay with it. I think you know that we've worked with you folks over the last 18 months to do exactly that. You raised a couple things in your letter that we think are probably not entirely accurate, specifically dealing with preferred stock. In fact, we actually think that the bill does exactly what you say you want it to do. We look forward to sitting down with you on that. There are other places where we think that maybe your concerns are a little bit misplaced. You have concerns, for example, about leverage and the impact on that on a retail investor. And we thought we had mitigated that by having that cooling off period, by having the BDC announce they were going to lever up in order to give folks time to get out of the investment if they were uncomfortable with that. So we think we've addressed some other things. Regarding the 1 year, I know you objected in your letter to the only having 1 year to write the rules. Keep in mind that that grows a little bit, Chair White, out of our experience. As happy as I am that we now do have the Jobs Act crowdfunding things, they're almost 3 years late. And so we're sort of trying to hold your feet to the fire as we do as Congress. Secondly, we do think that a lot of the changes that are contained in the bill are not going to require very dramatic changes in the rulemaking. It could be as simple as changing ratios or changing numbers or so forth. We're not doing a wholesale review, so we hope that when you guys sit down to do the rules, you'll see that maybe it will be easier to write these rules than you anticipated in your letter. Finally, and this is the big one, I hope that, when you first looked at it back, I can't remember, it was October, you didn't have a problem with a couple of different sections, specifically Section 60 of the bill, when you said, in your view, these provisions do not raise significant investor protection concerns. In the most recent letter, you say the exact opposite about the same section. So we do hope that when we do sit down, we won't have a circumstance where the goalposts move and we can simply
It was based on experience in between, but happy to work with you and your staff. Yeah.
Thank you very much.
Time of the gentleman has expired. Chair now recognizes the gentleman from Minnesota, Mr. Ellison.
Thank you, Mr. Chair. Chair White, conflicted investment advice costs investors a lot of money. Some have said $17 billion a year. And I'm very concerned that workers who sold IRAs with high fees and hidden commissions that damaged their retirement security. And I'm very supportive of the Department of Labor's decision to move forward with rulemaking to protect workers. The SEC and DOL have different jurisdictions, statutes, missions, mandates. For example, the SEC does not have the authority over insurance. I would prefer the SEC follow the lead of the Department of Labor in protecting the retirement accounts of workers. So I wonder, can you respond to that? I'd like to know what your thoughts are on this issue. Do you see there being a looming retirement crisis, and what role would a best interest of the consumer standard be, and what value would that be in terms of moving forward in this space?
Well, I mean, I think my own personal conclusion is I think I certainly have conveyed before, is that we should subject brokers and investment advisors to a uniform fiduciary duty based on the Section 913 recitation of best interest of the client, irrespective of your own financial interest. And that obviously applies to those classes of registrants. In terms of what the Department of Labor is doing, I've said before, they're a separate agency, they have separate statutory authority, and they're proceeding. Obviously, coordination is important. We do that with all kinds of agencies when there's some overlap. From our point of view, my point of view, and again, it's up to the entire commission as to whether and what the parameters would be of our uniform fiduciary duty rule. It would be done under Section 913 of Dodd-Frank, which, as you know, provides some parameters to our uniform fiduciary duty that takes some specific cognizance of the broker model, I think. And so, that's one of the things that, we would obviously have to be considering as we proceed under that authority, which is different than labor's authority.
Thanks. Also, when you were here in March, I urged you to finalize the CEO median worker pay ratio rule. Glad to see that the SEC has finalized that rule. Congratulations and thank you. The gap between CEO and worker pay has grown substantially, as you know, from 20 to 1 back around 1980 to now 300 to 1, which is really remarkable. Now, most people come at this from a moral standpoint, and they say it's not right and it's not fair, and I agree that they are right. But I want to ask you about something a little different. Is it good for the economy at large? And so I'd like to direct your attention to the graphic that I have. Many argue that paying CEOs in stock options encourages them to prioritize their personal short-term benefit over long-term needs of workers, investors in the firm. Many have called to eliminate the CEO performance pay loophole in Section 162M. And because stock options are considered performance-based under Section 162M, the deductibility is unlimited. Do you have any thoughts about this?
Well, I speak as the the chair of the SEC here. I mean, I think one of the things that that we've been very active in is disclosure of executive compensation. And indeed, we talked a little bit earlier about the 956 under the Dodd-Frank Act that we and fellow regulators are working very hard on, which is basically incentive comp to make sure that excessive risks aren't taken. I think I have to leave to others the broader issues, because that's really not in our remit, as they say.
Yeah, but do you agree that, I'm sure you're well aware when people talk about the disparity between CEO pay and median pay, a lot of times the argument is this right or not? Leaving that argument aside, do you have an opinion as to how a very wide disparity, say going from, say, 120 to 1 in 1980 to 300 to 1 like nowadays, how does that impact the proper functioning of markets, of retirement, of consumer demand? Do you have any views on that?
Well, again, I think where we operate in that space, if we do, in particular, would be in the 956 space, which is basically to try to ensure that the incentive compensation of executives, oversimplifying a little bit, in financial institutions is not done in such a way as to encourage excessive risk-taking, which obviously—
That's what I'm asking you.
Yep.
Do you think it does?
Well, I mean, we're doing a rulemaking with our fellow regulators to try to deal with that.
Appreciate your answers.
Time of the gentleman has expired. The chair now recognizes the gentleman from North Carolina, Mr. Pittenger.
Thank you, Mr. Chairman. Afternoon, Chair White. Chair White, in your opening statement, you clearly conveyed that you're committed to the three-pronged statutory mission: to protect investors, maintain fair and orderly and efficient markets, and facilitate capital formation. Included in that, do you read anything that would be considered social engineering?
I wouldn't, no.
Yes, ma'am. Well, in that light, over the last 5 years, you have spent thousands of man-hours and millions of dollars to defend rulemakings that really don't address the crisis and from our perspective, don't fit into the scope of mission, whether you're dealing with the conflict minerals issues or the resource extraction or the CEO pay disclosure rules that were just discussed. How do you relate your role in these issues? It seems to me to be a diversion, whether in terms of scope of mission. Is this an interest of yours? Is this something of the administration that you feel compelled to carry? Why would you move away from what clearly is your scope of mission? You're coming and you're wanting to increase your budget by 25%, at $1.5 billion right now, to go to $1.888. It's a significant amount of money. And it seems to me that it's expansion of your footprint. It's expansion of your role and expansion of the bureaucratic entrenchment of your agency. As we look at the federal government today, people are concerned. They see the overreach. They see the footprint of the federal government. They see the impact. Look at our economy. A very slow economic growth of 2%. Do you appreciate the fact that maybe this death by 1,000 cuts in terms of the over-regulatory involvement, the engagement in so many of these unrelated efforts are having an adverse effect that may be well-intended, well-designed by those who share those concerns, but killing the goose that laid the egg. I mean, you're in trying to protect everything, you're hurting the overall cause.
Well, first, I very much believe in furthering our core tripartite mission, and I think I've talked about that at some length, and it has several aspects to it. I think what you may be alluding to, at least primarily, are some of the congressional mandates that the SEC was charged by Congress, and it's Congress, to carry out. And what I said a little bit earlier is I do believe when I have a congressional mandate, that means I carry it out. We try as hard as we can to carry it out in as cost-effective a way and as consistent with our mission
Chair
as we
White,
can.
that fits into your scope of mission?
Well, it is part of the mission given to us by Congress. It's part of the mission given to us by Congress.
As you stated earlier, to protect investors, maintain fair, orderly, and efficient markets, facilitate capital formation. Do these extra additional forays, do they really fit into that scope of mission?
I mean, I think we can't talk about them as a group. I mean, I think, we've obviously done a number of the mandates that you might put in that category, but that we have, certainly see some investor advantage to. But, but again, if it's a congressional mandate, I think we have an obligation to carry it out in the best way we can.
In closing, if there are excessive disclosure requirements that hurt our capital markets, if that's true, and would you buy into that there could be?
Part of what we're trying to do with the disclosure effectiveness review, is to make the disclosures more meaningful for investors, and obviously not to create gratuitous.
We're talking about an excessive amount.
Yeah, I understand.
We hear from the market continually the excessive burden of these disclosures. They increase the compliance cost. They make it more difficult to raise capital. All these things have a combined effect to slow our markets and impact our economy. Would you agree that the reality is that these excessive burdens are really having an adverse effect?
Well, I mean, it's one of the reasons we do that very deep cost-benefit analysis that I was describing before. I mean, we obviously want to look at.
But let's look at the overall effect today.
Not burdening, but enhancing.
Respectfully, I've just got a few seconds left. Respectfully, can I say, look at the results today. It's all about results. Can you say, with all your good judgment, that all these disclosures, all these requirements, all these mandates, all these compliance issues have been healthy as it relates to growing and expanding our economy, or has it had, honestly, an adverse effect?
I don't think it's static. I think we have to be focused on, as these rules go out that we think are important, looking at exactly that.
Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from Florida, Mr. Murphy.
Thank you, Mr. Chairman, and thank you, Chair White, for being here. Good to see you. My first question, I think, was already somewhat asked by a gentleman from Massachusetts, Mr. Capuano, regarding petition 4637 on the shareholder funds for political activities. Just to dive into that a little bit more, as far as timing for a response from that, where do you think we stand, and what's the timing that you think we can expect to hear back from you?
On the letter, you mean?
Yes.
I mean, as I said, I have said earlier, I have I think 3 relatively recent letters, some from members of this committee, another one from different members of this committee, and I'm expecting to respond to them fairly shortly. I mean, as I've also said, though, we are focused on our mandated rulemakings and mission-critical initiatives that I've described.
And just to make sure, my understanding there's been 1.2 million comments put in, that this is a record, I guess. Just to make sure you feel that that is sufficient to move forward.
Well, there have been a lot of comments on this and very strong views on both sides. I think there are about 2,000 unique comment letters. I mean, there's clearly intense interest on both sides on this issue. I think one of the things I mentioned before is that, I watch sort of what's happening in terms of, companies, the shareholder petitions that are being filed. That's through our regulations that's made possible, and the number of companies increasingly that voluntarily are making those disclosures. There's a recent survey out, I think, just in the last 2 or 3 days, showing those numbers are up.
Okay, thank you. And then as it relates to DOL, and they're moving forward on fiduciary duty, I know there's been some questions on that as well. Can you just elaborate a little bit more on the distinct responsibilities between SEC and DOL and how you plan on moving forward with this?
Sure. I mean, essentially, 2 separate agencies, 2 separate, statutory regimes. The Department of Labor obviously is responsible for the very important ERISA space and has been for, since 1974, I think. And again, I think I mentioned this a little bit earlier, but actually, even as it exists now, brokers, for example, who are our registrants who are in the ERISA space or parts of the ERISA space are subject to different DOL rules and different rules under the securities laws and regulations. So I think each agency has to judge for itself how it is proceeding. With respect to the SEC, we don't have a mandate to proceed with the uniform fiduciary duty, but we have authority given to us by Dodd-Frank in Section 913 to do that. I personally, after lots and lots of study, made the judgment that I think we should proceed with analyzing rulemaking to impose a uniform fiduciary duty consistent with Section 913. There's a lot of analysis to do on it, economic and otherwise, and it's complex and not a quick exercise. I think Department of Labor's initial proposal on theirs was actually in 2009.
Yeah. I think one of the concerns I think we all have on both sides of the aisle is duplication and that multiple agencies are looking at the same exact thing. I know you've had some meetings with Secretary Perez and hopefully, I'm sure, having these conversations of staying in your lane and who's doing what. I think we all want to get the bad actors out, but at the same time don't want duplication. We want taxpayer money spent as wisely as possible. Have you had that conversation? How do you see that heading?
What we have done, and I think this is, again, before I was here, but I think really from 2009 forward, and then obviously I'm familiar with the more recent contacts, is to provide the staff of the SEC, this is not a commission, but I also participated in some meetings with Secretary Perez, is to provide technical assistance and expertise from our space to them. Our economists met with them on a number of the issues. And I think, as you do, and frankly, any time you overlap with any other agency, take the CFTC on swaps and securities-based swaps. You each have your authorities. They're somewhat different sometimes. You try to be as consistent as you can because obviously it's not good for market participants if they have 2 sets of rules that they have to comply with. But often there are different markets, different statutory obligations, and so there's not perfect consistency. But it's very important as you go forward on anything that overlaps that you talk and try to do what you can to conform.
We're running out of time, but real quick, can you just talk briefly about what you think the SEC's role is in cybersecurity? To me, that's one of the biggest threats.
It is one of the biggest threats and risks we all have. I mean, full stop. I mean, the SEC has sort of 3 areas of sort of specific, I would say, jurisdiction. I mean, one is we did, I think in November of last year, our regulation SCI, which is Security, Compliance, and Integrity, that essentially is a rulemaking with respect to our critical market infrastructures to raise the bar on the resiliency of their systems and report incidents to us when they, and others when they actually have them. Part of that is cyber. We deal with the brokers and the investment advisors and their risks. We put out disclosure guidance, and we stay as active in this space as we can. We also bring enforcement cases when people don't do what they're supposed to under our rules.
Time of the gentleman has expired. The chair now recognizes the gentlelady from Missouri, Ms. Wagner.
Thank you, Chairman, and welcome, Chair White. I wore my Kansas City Royals blue to make you feel welcome from your first 10 years growing up with the world champion Royals.
But I'm a Yankee fan, I told you.
I know. I'm a Cardinals fan.
Okay, all right.
So,
okay.
in following up on some of the questions that have been asked about the DOL fiduciary rulemaking, I do want to associate myself with my friend and the gentleman from Georgia, Mr. Scott, in the SEC's absolute purview on anything having to do with the uniform fiduciary rule. And following up on what the chairman said, you talked about the last SIFMA annual meeting about this full-out focus. So what does full out mean to you? When can we expect a rulemaking?
Yeah, I mean, again, I want to make clear at the outset, this is my view. It'll be ultimately a commission decision. I've obviously given the staff direction, and they're very, very actively working on it. It's complex. It's not quick, but we're working toward, in the very short term, most of the details of what the proposal would be. Now, that doesn't suggest in 2 months you're going to see a proposal. I mean, this is a long, complex exercise, and it has to involve the full commission.
It does, and I'm glad to see that you're looking at the shorter term rather than the longer term. And obviously, you'll need to come back before this committee and Senate banking. You have to talk about alternative remedies to a uniform fiduciary standard that would address investor confusion, including simplifying of titles and enhancing disclosure. All of these things are things that I hope are a part of this ongoing analysis. David Grimm with your Division of Investment Management stated that further analysis still had to be done. What is the scope of that analysis, and what do you anticipate as a timeline for completing it?
Yeah, I mean, again, I cannot, kind of overstate the complexity and the importance of getting this right. And part of that is clearly the very deep economic analysis that our economists will do as we're proceeding, with this. So in terms of impacts, in terms of, for example, I think I've said this before, I mean, if we ended up at the end of the day with a rule that imposed that uniform fiduciary duty, but we deprived retail investors of reliable, reasonably priced advice, we would not have succeeded, obviously. And so our economists, have a lot of work to do as we proceed with this.
Well, and you're right. We have to get it right, and I think the DOL's proposal is 1,000 pages wrong. So can you tell us about, in your analysis, including in the studying the impact of the DOL's proposed rule on investment advisors registered with the SEC?
I mean, I think, it would have impact, I think, on investment advisors as well as broker-dealers. I mean, what we did with the DOL proposal, though, was essentially, as I mentioned before, provide the technical assistance to them, which included, from our staff, and it's our staff, providing how it might impact on investors and how it might, what the lay of the land is now in terms of how brokers operate, how investment advisors operate. I mean, it really depends on, and obviously the Department of Labor is taking in a lot of comments about impacts, and so it depends on, how that ends.
Tens of thousands of comments. And in fact, I received a letter from Secretary Perez saying that they were going to make no changes, no reproposals, even prior to the public comment period opening up, and I'm very dissatisfied with this. I know you've said that you're taking are providing technical assistance, and in that quote before Senate banking, you even talked about particularly the lower end, which I care deeply about, in terms of customers' choice, access to products, cost of those products. I think that's absolutely key. Do you have any concerns that some U.S. investors could potentially suffer based on the new fiduciary definition that the DOL is proposing?
Well, I don't want to comment on that specifically, other than to say that I think the Department of Labor is, and certainly, our technical assistance was included, that concern as you proceed with any rulemaking, and we have it in proceeding with ours.
Well, I'm just looking at a couple examples here on how the DOL rule, I think, conflicts with securities laws. And, I understand that DOL's fiduciary duty rule will require financial advisors to provide 1, 5, and 10-year projections on investment returns as part of projecting investment costs under the best interest contract exemption. Does this potentially conflict with the Investment Advisors Act of 1940, especially its anti-fraud provisions?
Well, I mean, I think I'd have to analyze that with my folks in the Investment Management Division specifically, but what I indicated earlier is even now we have different rules in the ERISA space. It's different statutory authority that apply to our brokers, our registrants, than the federal securities laws require. But I'm happy to get back on that specific one.
I'd like you to take a look at that, and also just with the indulgence of the chairman, take a look at the DOL, their definition and term on recommendation. It differs completely from the definition used by FINRA. So I am concerned about some of these differences and really reiterate, this is the SEC's purview through 913, and we would love you to move as quickly as possible. Thank you, Mr. Chairman.
Time of the gentlelady has expired. Chair now recognizes the gentleman from Colorado, Mr. Tipton.
Thank you, Mr. Chairman. Chair White, thanks for taking time to be able to be here today. You've previously stated that the independence of the SEC should be respected and noted your particular expertise in terms of dealing with a variety of issues. And with that in mind, I believe that it's important that we consider the Federal Reserve's work on mapping transactions within the capital markets. And many view this as an early stage to be able to have the Federal Reserve regulate much of the capital markets under the guise of complex transactions. Are you fully committed to making sure that the SEC maintains its position as the regulatory body?
Yes. I think one has to recognize, though, that after Dodd-Frank, there were some reassignments of some things, and so we end up doing, more things in consultation with, the Federal Reserve by statute. I'm not saying that's bad. I'm just saying, but the short answer to your question is yes.
Great. If the Fed does continue this policy, however, with securities products and firms, if they're going to be regulated under bank-centric modes, what type of an impact will that have?
Well, it's hard to answer that in a vacuum. I mean, I do think, and we've discussed it in connection with asset managers and our doing stress testing as we're required to under Dodd-Frank. One has to recognize that asset managers are different than banks, and so that means that however you regulate, however you stress test, if you do it optimally, it's going to be different.
Yeah, and I think that's actually part of the concern that we're seeing is some of this being formulated, that if we're going to see, and that this seems to be the track that they are on, to be able to try and de-risk completely, that it's going to impact some of the work that apparently you're trying to do in terms of being able to have some capital formation, access to capital, because that's some of the big issues that we're hearing in our communities, simply for small businesses to be able to actually, to be able to reach out. Do you believe it's important that the FSOC have decided to review activities and products in the asset management industry for systemic risk?
Do I think it's important, do you say?
Yes.
I think it's a focus that makes sense. I mean, and it really goes beyond asset management. I think I think I cited before the example of securities lending is one of those activities. Obviously, that's not just asset managers. I mean, FSOC really is charged with, looking for systemic risks and addressing them in the system. They have certain authorities to deal with them. But I think the pivot, at least for the time being, from a firm focus, to products and activities makes sense. The SEC staff has been quite active in I should say, the December requests for comment on those risks. I see their work as complementary to ours, but we obviously are the primary regulator of the asset management industry for 75 years, and we're proceeding with a regime of regulations that we think is important to do and makes sense to do, and that's completely independent from FSOC. I think what they're doing is complementary.
Okay. Well, appreciate your answer on that, but one comment that you just made in terms of going through and seeking comment. One of the big concerns, obviously, in my district and maybe nationwide, are small businesses. You have the Government Business Forum on small business capital formation, and the response from this forum comes out. And what do you believe are some of the most specific issues that small businesses are talking about right now?
I mean, there are a number of them. We actually have that meeting tomorrow, by the way. Our annual forum is tomorrow morning, just for the day. Enormously useful. I mean, I think if you look over the years, I mean, there are a number of the recommendations from that forum. I'm not suggesting all of them, that we've actually proceeded with. I mean, clearly there was a lot of interest in crowdfunding. There's a lot of interest in A+. One of the things we did, by the way, when we did crowdfunding, is that we also proposed to amend our Rule 147 and Rule 504, which really is addressed precisely at those small in-state businesses that want more facility to raise capital. And so, we're and that goes beyond the Jobs Act. That's not something mandated. That's something they were very excited about, as were frankly, the NASA state regulators.
Great. I do think it is worthy of note. Pepperdine University did conduct a study, and it said that 53% of the respondents, small businesses, believe that the current business financing environment is restricting growth opportunities, and 46% believe it's restricting their ability to be able to hire new employees. So I would encourage you, as you're holding those forums, not only to listen, but to actually hear what they are having to say, because these impacts, cost-benefit analysis that you've been speaking to, are having a real impact. And Mr. Chairman, with your consent, I'd like to be able to also submit a question for the record in regards to the 10K filings on a lot of our mining industries, and be able to get a response from that.
Without objection, the time of the gentleman now has expired. The chair now recognizes the gentleman from Texas, Mr. Williams.
Thank you, Chair White, for being here. And you talk of your support for small business. I'm a small business owner. And you support the International Financial Reporting Standards. And as you know, the IFRS does not allow the use of last-in, first-out accounting. My concern is if we transition from the current U.S. method of GAAP accounting to IFRS, the toll on U.S. businesses whose LIFO accounting would be unsustainable and, frankly, cause most of them to go out of business. I think the number to be recaptured is somewhere in the range of $100 billion. Now, you've publicly stated that considering whether to further incorporate IFRS into the U.S. financial reporting system is a priority of yours. Last time you were here, I believe you told my colleague, Mr. Barr, that your objective was to get a single set of global standards. But while FASB and IASB have made attempts in the past to come to an agreement, those efforts have always been unsuccessful. I saw in comments I believe he made yesterday that Chief Accountant James Schnurr urged supplemental use of global rules for U.S. companies. Yes or no, do you have any comments on how it would work? Do you agree with that? Do you agree that it should be supplemental?
Mr. Schnurr's actually, I think he said he made a recommendation to me. He also made a speech, I think, last December about that. And certainly I'm, quite interested in that. Just to be clear, what I've said, though, is I think the Commission, if we can, should speak again on this issue. Just speak again. I'm not saying what that would be. So I think in terms of the sort of the one high quality global standards, I mean, I think, as a goal, I certainly favor that. That doesn't answer all the details along the way. It doesn't for a moment suggest, what the position might be for further, application of IFRS and domestic. They obviously apply to, foreign private issuers now, but that's very different.
Based on those comments, who, by the way, also said there's virtually little or no support among U.S. companies for a wholesale change, do you still consider incorporating IFRS as a priority of yours? Yes or no?
Again, I don't think I ever stated that as a priority of mine. My priority was to get the Commission to say where we are.
Okay. Is your inclination to adopt IFRS based on a desire to have one standard worldwide financial reporting system, or is it because you believe the IFRS standards are preferable to GAAP?
Again, that's not, what I at least intended to convey. I mean, I think it's obviously the SEC some time ago before I came in, by regulation has allowed foreign private issuers to use IFRS without reconciliation. But plainly, the convergence projects have gone where they've gone and not gone where they've not gone. Right. And so there are differences in the system.
In the case of last-in, first-out inventory reporting, IFRS does not allow the use of LIFO. In contrast, the U.S. tax code requires the use of LIFO for financial reporting if it's used for tax purposes. Effectively, then, the SEC would be making tax policy. Are you aware of this potential impact?
I mean, I'm aware of the impact, but I don't want to apply for the moment. I think it ought to be done, period. Yeah. But clearly, it's got IRS and IRC implications.
Do you think you should be effectively setting tax policy?
No.
Okay. Do you have a substantial position on the use of the LIFO inventory method?
I don't. I mean, obviously, it's the method under GAAP is the one that applies.
You realize, though, what a destruction would be to small businesses here.
I'm quite aware of the complexities of that issue, absolutely. All I want to make clear is that I think some of the, positions that you're indicating were mine really are, I haven't concluded on any of that. My only priority is to get the Commission to say where it is on some of those issues, not suggesting for a moment, where that would be.
Have you consulted with the Treasury about this potentiality? And if so, is the Treasury comfortable with the SEC setting LIFO inventory tax policy?
The answer is I haven't consulted with Treasury on this because it's not ripe at all to consult with them on it. I mean, not because it's not an important issue if we were to reach it.
LIFO is important.
Very important, yeah.
Accounting method for small businesses.
Absolutely, absolutely.
And the recapture of $100 billion as I said earlier, could devastate small businesses. It could cost jobs. So I appreciate your following through on that.
Absolutely.
Thank you, Mr. Chairman. I yield my time back.
Gentleman yields back. The chair now recognizes the gentleman from Maine, Mr. Poliquin.
Thank you, Mr. Chair, and thank you, Chair White. Appreciate it very much. I know you missed your opportunity to go to Maine this summer, but I know next year is another year, and you'll make it
I'm
up
coming.
for vacation. Spend as much money as you can. I appreciate it. Chair, the state of Maine has the oldest average age in the country. In Maine 2nd District that I represent, which is western, central, northern, and down east Maine, is likely the oldest district in the country. In addition to that, coast to coast, there are 40 million Americans that live in rural areas. Now, in the parts of Maine, and I'm sure other parts of the country, when you're living in those areas, we often don't have internet connectivity. We have power outages all the time, even if we did have connectivity. In addition to that, we have 41% of our seniors in this country, regardless of where they live, that don't use the internet. So I know your mission, in part, is to make sure our investors receive all the information they can to make sure they're protected in the decisions that they're able to make. Now, one of your own studies back in 2012, Chair White, indicates that 71% of investors, regardless of age, prefer to receive their reports from mutual funds and what have you on paper. Now, right now, there is a proposed rule under your shop, 30E-3, that you and I talked about back in August.
Yes, we did.
And in this rule, if I'm not mistaken, a mutual fund company can simply send a letter to a senior or any other investor saying, you know, you are no longer going to receive your quarterly statements or your portfolio holdings or whatever it might be, unless you fill out this form and send it back to us saying that you want to continue to receive those reports in paper form. Now, what happens if the mail doesn't go through? Or what happens if you're on vacation in Florida and you live up in Madawaska, Maine, and the letter gets lost in a snowbank? Or what happens if you've changed locations and you're in between addresses, or you're on some other reason you're away from home? And this is just not fair, in my opinion, Mr. Chair. It's just not right. So I think when it comes to, with all due respect, when it comes to the mission of the SEC that I know you're responsible for upholding, that it makes a lot of sense to make sure that our investors have the option of receiving their paper financial reports unless they opt out. Otherwise, it's much too confusing. Now, if someone decides to opt out instead of opt in, that's all fine. So I am hopeful that you will commit to me today that you will retain this option, because that is, with all due respect, part of your mission.
I can't commit today because we have an open period of comment until January on this. What I can say, and I think we talked about this to some degree in fact, I know we did on the phone, is that the proposal, although again, we have a number of comments in the same vein as yours, which we're obviously weighing very seriously. But in the proposal, the staff has tried to build in, you know, it's not just sort of one letter that gets lost in the mail, which I understand is a risk, don't get me wrong, but also it would periodically, you know, again, would be solicited on the issue. So some of the problems that have been identified in terms of sort of receipt and choice, the proposal tries to address, but I fully take your, you know, comment about switching the presumption, basically.
Chair White, my mom, who I love dearly, is 87. She can barely use a cell phone.
Right.
And, you know, Mom and
But
Dad
again,
are
she would have the
still-
option not to receive it, you know, I mean, she could get paper under, but I fully take the concern, yeah, fully
Appreciate
take
that
it.
very much. I have a very short amount of time left. I'd like to more if I can. Chair White, thank you very much. You know, our financial services industry is the envy of the world. And it gives all kinds of options to investors saving for their retirement or for their kids' education, and also is the backbone, the liquidity to our economy that allows us to grow and raise capital and hire more workers. I'm very concerned, and you and I talked about this a little bit this summer, I believe also, about asset managers and pension fund managers and mutual funds being designated as SIFIs. And in particular, I know there's been a movement through FSOC and also some of the other folks that come before us, that you're starting to look at activities instead of asset size. Now, I would like to ask you, if I can right now, what activities are concerning yours? Because if French and I manage a couple of different pension fund funds, mutual funds, and his performance is better than mine. It would be. it would be, then my clients will go to his, and the assets are not on our balance sheet anyway. They're held in a trust department down the street. So if something happens to me, it's no systemic risk to the economy or to the capital markets.
And I think that's why you've seen the pivot to products and activities. I mean, for example, one of the, and frankly, we're dealing with this in our separate, primary regulator space too, is liquidity risk management kinds of issues, just to make sure that, because in an open-end fund, you're entitled to, get your money, right away, those kinds of risks. I mentioned before securities lending, which asset managers and other people not even under the SEC's jurisdiction may use, and does that pose any risk? But it really is, there are no answers there. It's really just, asking questions. And I think it's good to ask those questions.
I will submit to you, Mr. Chair, Chair White, that there is no risk in the asset manager business model to the economy. And please look at that very carefully and make sure, with your position on the international regulatory bodies, that you make sure that we stand up for American asset managers when it comes to any regulatory issues with respect to our industry. Thank you very much. Have a wonderful Thanksgiving.
No, thank you, too.
Mr. Poliquin. And the gentleman from Arkansas.
Thank you, Mr. Chairman. Madam Chair, thank you for being back before the committee, and congratulations on a good GAL audit. I know that makes every management team smile when you get that. And also congratulations on clearing up some of your 50 front burners. Maybe you're down to 40 or so now. I'd like to start out by talking about equity market structure. Sure. I thought SIFMA wrote a very thoughtful piece last July, I think, in 2014, about their suggestions on equity market structure challenges that we've seen over the course of the past few years, including some of the references to this summer. And you've now formed an equity market structure advisory committee. And a couple of comments about that I'm concerned about. I'd like to get your thoughts. I understand they plan to have subcommittees meet in private without any transparency on their policy recommendations. I'd like your thoughts on that. And then I noted that the overall membership in the committee didn't include NASDAQ, it didn't include the New York Stock Exchange, it didn't include a big retail broker-dealer, and I come from the retail broker-dealer space, so I'm always concerned about best execution, the promise that we make to you as our regulator to achieve best execution. So I'm concerned that those entities are not involved in your market structure advisory committee. Could you respond to that, please?
Yes, happy to respond to it. I mean, first, the commission, and it's really all 5 of us on the commission, went through a very lengthy process of, of vetting and of trying very hard to diversify from points of view, expertise, the 17-person committee, which is what it is by charter. And so there is an exchange, obviously represented on the committee. There actually, as it turns out, 2 other representatives who were formerly actually at primary listing exchanges as well. There is a representative who represents the retail brokerage point of view, although, we still keep looking at that. I mean, and we've clearly had requests for others to join. One of the things that we've done, and again, this is something you just keep looking at because you really want that diversity of perspectives, is to structure that committee so that we get input from others from every constituency, whether it's retail broker or it's NASDAQ or it's the New York Stock Exchange. And so each of the meetings, in effect, is a roundtable, where we have NASDAQ and New York Stock Exchange and so forth. And the subcommittees, that's something that the other advisory committees use to great effect to just get things done, but they don't decide anything, and they are also able to, open at least parts of their meetings if they choose publicly.
Let me urge you to open those meetings or parts of those meetings, and let me urge you to make sure you get full complement of those who want to participate in this process in the retail industry, and particularly you can say you include exchanges, but to not have the 2 leading exchanges, NASDAQ and the New York Stock Exchange, not represented strikes me as short-sighted. Let me switch gears. Generally, in your experience, I know you've got an enforcement and legal background, and I've got an investment management background. Do you believe that retirement fund managers have the principal obligation of maximizing long-term returns for their beneficiaries and their plans? Is that a general thing you bring to the table as a belief that that's their primary objective?
I mean, I don't, I think and maybe it's because of that legal, background and just sort of the SEC's, jurisdiction. I mean, I think that it's, you want to serve the best interests of your client is what you want to do. That's what the Uniform Fiduciary Duty is about also.
Yeah, and I think if
yeah.
if you have full discretion over an account and you're an investment manager, I mean, you've got to act in their best economic interest, wouldn't you say?
Yes.
Well, that causes me concern about a recent decision by the Department of Labor, not the fiduciary standard, but Secretary Perez has recently encouraged and has given guidance to institutional managers that environmental, social, and governance issues are equal to economic return issues. And, we live in a world of underperforming defined benefit plans that aren't fully funded, and yet we have direction from the guy who's in charge of ERISA to look at other things besides economic performance. Want to take a response at that?
Do I want to, or
well,
would you like me to?
It's so much fun to do it.
I mean, look, I don't want to comment on the specific comment. I mean, I will say that I think, what you, and it's a little out of my, but I think what you are trying to do is serve the best interests of your client. I mean, obviously you can have a client, who says, look, I care about this, 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 and this as you invest for me.
Economic
That's really up to your client.
We're not fully funded, and economic returns are how we achieve that. And I think the Department of Labor is way off track there. Last question. You've got some vacancies on the commission. And would you commit to this committee that you wouldn't bring controversial or elements up if you don't have a fully functioning commission that has bipartisan members on it?
Anything could be controversial. I mean, I think what...
True, but I mean, any big major issue follow-on that we're working on, I mean, we're concerned that you're going to not have a fully functioning commission with bipartisan appointees, and we'd like your commitment that you'd be cautious about what you try to bring through the commission without fully confirmed bipartisan appointees.
I do think the work, right now we're 4 of us, I guess 1 independent, 1 Republican, and 2 Democrats. And we're moving forward with our agenda. I think we can. I mean, but I will say, I mean, I'm going to, I sort of take everything into account. What I can't, I do think we should proceed. I don't know, obviously how fast confirmations, assuming they occur, which I assume they will, occur. But, you obviously sort of read your agenda as you go along.
Thank you. I yield back, Mr. Chairman.
Thank you, Mr. French. Mr. Rothus.
Thank you, Mr. Chairman. Thank you, Chair White, for being with us today. Just want to touch on the some of the folks have been talking about the bond market, corporate bond market. Just wanted to ask a question about that. Has the FSOC, again, of which you're a voting member, ever conducted any analysis of the systemic risk that could result from a lack of liquidity in the corporate bond market due to regulatory initiatives like the Volcker Rule and Basel III?
I don't think as phrased that way. Obviously, the 4 or 5 of us who report quarterly to this committee do that kind of assessment, at least in terms of the Volcker Rule.
As you know, the chairman reached out to you at the beginning of the year for a status update on a number of initiatives that are designed to facilitate capital formation and ensure that the U.S. capital markets remain the leader rather than focusing on politically divisive issues. For example, the chairman asked for the status of potential SEC efforts to modernize the rules governing transfer agents. This topic, although highly technical, is of interest to me because the rules have not been updated since the 1980s. I also think it is a rare occurrence when you have bipartisan support within the SEC, given that former Commissioner Gallagher and current Commissioner Aguilar, their statement in June of this year. In February 2015, you stated in your response letter to the chairman that the SEC staff is considering recommendations. I would like to follow up with the chairman's request for a status update as of today.
Yeah, we're actually quite actively focused on the transfer agent issues. I don't want to get sort of ahead of what we're going to do or give you a specific date, but I think you'll see something coming out quite soon. I don't want to say what time, but I mean in the next couple of months.
In what form would that be?
Well, I don't want to say that until it comes out, because that's, I mean, one of the things that you're having to balance with that is because we haven't updated it for 40 years, you need some data to inform yourselves, in terms of some of the things that you might propose. There may be other things that you can, tee up as a direction you think you're going in as part of that. So that's really what we're kind of trying to balance, to do is, to be as pinpointed as we can, but also make sure we, get the input we need by whatever form we put this out in.
So you haven't made a determination whether it's going to be a concept release or some other release?
We have not, although we're thinking about maybe some combination.
Also, it's Mr. Gallagher and Commissioner Aguilar said, quote, a lengthy delay in updating the Commission's transfer agent rules would be bad for the markets, investors, and issuers. A concept release may be warranted to gather additional information and viewpoints on certain topics, but there are critical reforms requiring immediate action that we can propose now. Would you agree with that?
Yes, and not only do I agree with that, I asked them to do this. And I was, in other words, to come back with areas of agreement. So I do agree with that.
Let's see. You have questioned whether SEC disclosure powers are best used to address societal ills, noting in a speech that, quote, other mandates which invoke the Commission's mandatory disclosure powers seem more directed at exerting societal pressure on companies to change behavior rather than to disclose financial information that primarily informs investment decisions. That is not to say that the goals of such mandates are not laudable. Indeed, most are, seeking to improve safety in mines for workers or to end horrible human rights atrocities in the Democratic Republic of the Congo are compelling objectives, which as a citizen I wholeheartedly share. But as the chair of the SEC, I must question as a policy matter, using the federal securities laws and the SEC's powers of mandatory disclosure to accomplish these goals, close quote. What is the cost to investors when there is an overemphasis on mandatory disclosure requirements that seem to be targeting societal ills rather than what may be considered, quote, material, close quote, by a company?
I mean, it's hard to say what the cost is, obviously, and investors can see things differently. I think I went on in that speech to say, though, if there's a congressional mandate, even if, as described in the prior remarks, I do consider that our obligation to carry out.
Well, as you know, last April, a U.S. Court of Appeals found that the SEC's conflict minerals rule violated the First Amendment because it required companies to shame themselves. Given the political and shaming nature of the pay ratio rule, is it unreasonable to assume that the pay ratio rule will likely also violate the First Amendment?
We certainly studied that precise issue, and we believe it comports with the First Amendment.
This week, Commissioner Piawara proclaimed that the SEC's corporate disclosure regime has been hijacked by social activists. Do you agree with Commissioner Piawara that the SEC's disclosure rules are meant to serve investors, not special interests?
Well, I certainly agree that our disclosure regime is meant to serve investors. Again, I think that if they're mandated disclosure rules, we have an obligation to carry them out. It's the law.
Can you explain how the SEC's pay ratio rule serves investors over special interests?
Well, I think and again, it's in the release. I mean, I think what the pay ratio rule does is, and it's a mandated rulemaking, obviously, is to provide investors another data point in judging a CEO's compensation. That's the finding in the release.
Yield back. Thank you.
Thank you, Mr. Rothfuss. It looks like it's just us.
Okay.
A couple of things, Madam Chairwoman. First off, you've always been very kind to me. Your staff has been terrific. And because of that, I'm just going to yield myself as much time as I might consume because I got a lot of questions.
Okay.
Oh, you already hit the clock on me. Okay. This is I'm going to ask you almost for a narrative answer on this. And I pretend no one's watching or listening.
Uh-huh.
Being someone who was both, I think, intellectually and emotionally vested in crowdfunding, in the Jobs Act, and Reg A+. But let's use Jobs Act and the crowdfunding portion. Almost 4 years. Almost 4 years beyond when the rules should have been done in something that from the IQ you have around you and yourself should not have been very complicated. I beg of you, could you walk me through what happened?
I don't think it's 4, it's 3 years, I think. Not that that's answers
okay,
you, but right.
3 plus
right.
what?
Right.
I'll give you, let's call it 3.
Okay.
Look, your staff and others were very kind to let us see some of the letters that were coming from certain union front groups and other groups that disparage crowdfunding. But help me understand, because as this hearing is supposed to be about resources, Was this a resource issue? Was this a political issue? Was it an intellectual capital issue? Why so long?
I mean, clearly, I won't, but I have already, described, how our need for resources really across the boards. But this is one where, and I think I believe I testified to this in March when I was here. We knew this rulemaking was going to be very complicated going into it because the statute is quite prescriptive in some areas. Funding portals, which are enormously important to investor protection, is a complicated piece of that as well. And then, so we did our proposal. I mean, I sort of really tried to light a fire under the proposal. We got it out pretty quickly after I got here, I think. And then the comments came in, and so we were, trying. And again, we have to work within the statute when it's prescriptive. But we try to make it.
Also, the statute actually had some deadlines too. So.
Yeah, no, I'm just saying we do need to observe those. Obviously, some places give us discretion, some places don't. And the goal is to make it workable and to safeguard investors in the new marketplace. And that proved to be very difficult.
But in what I was asking in my question design, and maybe I need to do this in writing because some of this is uncomfortable, is the power of certain activist groups to delay something at the same time, both the right and the left here get behind these microphones and talk about the desperate need for economic growth and the new economy and the future that brings us, and then some of the things that we tell our constituents we're doing for them to grow the economy take 3 years to get a rule set done.
But again, I'll give you my own perspective. We're talking in the context of crowdfunding. I mean, this was pure on the merits, get it workable, get it to protect investors. There's no politics, no activism, no anything.
But in that same time, what, a dozen and a half, 2 dozen states actually did their own and produced their own rule sets and are up and running.
Right. Yes, but they also, did not have the same statutory framework we had to work with, and it's not a federal rule. And I mentioned it earlier, one of the really important, I think, exciting things we did the same day we did crowdfunding are these amendments to Rule 147 and 504, because that is really quite solicitous of those state crowdfunding statutes too. I mean, obviously it's a proposal at this point, but I mean, I think, that is a good thing.
If done robustly, there is actually an interconnectivity there that actually could be very helpful for the economy. And this is one of those, just because as I was walking out to grab a meeting, I thought I heard something in a previous question, I think with Representative Lukemeyer, and it sounded like the regulatory or additional regulatory scrutiny when an investment organization will pledge their holdings up for shorts or a loan on their book. Did I pick up something there?
I don't think so.
Okay.
I mean, I don't think so.
All right. Last one, it's also important to us. We accept your commission, the board right now, you're short one Republican. There is a certain nervousness out there that in the waning days of an administration, the independence of the SEC, this is more of just a request for your greatest prudence as rules are being brought, for a vote of yourself and your fellow commissioners, that you are shorthanded, and something that would be controversial, have a cascade effect, policy-wise, be dealt in that light that there's a voice missing.
Yeah, again, I think literally and otherwise, I'm extraordinarily, independent. We try to do these rulemakings on the merits. Obviously, I think we've had an allusion to the 3-2 votes that we've had, and that's sort of part of the landscape, I think, at this point in time. But, I think we need to move forward with the agenda, but I certainly will be, sensitive to all things.
And because I have no one else waiting, and I'm going to give myself a couple extra moments here. For the SEC and your team, how much interest and focus is there, shall we say, on the new economy? As we see, Silicon Valley is spending lots and lots of resources trying to find ways to provide financial service type products, lending products, crowdfunding platforms, or other types of platforms. Do you have someone on your team that actually now is specializing in trying to say, this is our future, this is coming at us, here's new tech?
One of the things that, yes, is the answer to that. I mean, we, at least as I'll describe it, I mean, one of the things that we've been doing for the last several years is to make sure that we have you know, I'm going to call it the market expertise, but really the points of view that would, you know, encompass the new products, the new innovations.
Are there some things, because this is one of the things in our lives that actually may be bipartisan, are some things we can do as policymakers to provide you tools or statutory mechanics to allow you to embrace and run with those ideas that are good and do it as fast as possible, so we're not slowing down what many of us believe is our future of our economic growth, and that's the new economy?
I mean, what really helps us is that, you know, that outside expertise, genius, you know, that we make sure that we, you know, we have in-house when we can, and we do try to do that.
Okay. Chairman White, thank you so kindly for your patience and the time you gave us today.
Thank you very much. Thank you.
I'd like to thank our witness, and without objection, all members will have 5 legislative days into which to submit additional written questions for the witness, which will be forwarded to the witness for her response. I ask our witness to please respond to these promptly, which your team has been pretty good on many of the things we've sent you. Without objection, all members will have 5 legislative days in which to submit extraneous materials to the chair for inclusion in the record. And with that, this hearing is adjourned.